Ladies and gentlemen, welcome to the Impact webinar hitting the 320 billion hydrogen market, strategies for boosting offtake and attracting buyers. My name is Molly Huang, Head of Content at Leader Associates, and it's my great honor to be your host for today's session. In the dynamic global hydrogen market, over 1,000 projects are driving a significant 320 billion investments. Yet only 11% progress to the final investment decision stage, revealing a notable gap between announcements and actual implementation. Today's webinar comes at a crucial juncture as the hydrogen industry must transition from ambitious target to actionable outcomes. We hope today's webinar can provide all of you with greater clarity and understanding to the question during this pivotal shift. This webinar also marks the global launch of our upcoming physical event, Investing in Green Hydrogen 2024, scheduled on September the 2nd to the 3rd at Queen Elizabeth Centre in London of UK. The IGH 2024 anticipates over 800 industry C-suites, including policymakers, developers, investors, financiers, off-takers, and key value chain partners. We extend heartfelt thanks to our energy transition partners, RWE and ENGIE, future energy sponsors, Mazda and Uniper, sustainability partner, Fosq, sustainable port partner, Port of Antwerp, and Lenya sponsor, EMBW, among others. We also express appreciation to our esteemed early confirmed speakers, including representatives from the Scottish Government, the Government of Norway, the German Federal Ministry for Economic Affairs and Climate Action, the International Renewable Energy Agency, ARENA, and many more prominent industry leaders. Thank you for contributing to this important dialogue. Now let's review our agenda for today. We'll divide today's session into two main segments. First, we'll explore shaping policy instruments, where we examine global hydrogen supply-demand trends and learn from pivotal policies such as the UK's hydrogen production business model, the European Commission's R&D pillars, and Germany's H2 Global in scaling the market. Next, we'll focus on igniting commercial confidence, featuring insightful keynotes on leveling up private investment, green ammonia contracting, and project finance. Lastly, a panel of industry leaders will also share their perspectives on the intricacies of offtake, a crucial theme for 2024. Before we begin, please note that this webinar is being recorded and will be shared online. We encourage active participation in a Q&A box following each of the presentation. Without further ado, now let's commence our first segment with Mr. Jose Bermudez, Energy Technology Analyst and Hydrogen Lead at the International Energy Agency. Mr. Jose, over to you.
Thank you very much, Molly, and welcome everybody. It's a real pleasure to be here today and to have the opportunity to present some of the analysis and the insights from the analysis that we are doing at the IEA in terms of developments of the hydrogen market. If you give me just a second, I am going to share my presentation. Okay. Can you, Molly, please confirm that you are seeing it well?
Yes, I can see the slides.
Okay, fantastic. Then let's move for it. Well, as I said, I'm going to explain you a bit the main trends that we are seeing from our analysis of the development of hydrogen, low emissions hydrogen in general, in terms of supply and demand. And I will let you know that most of this analysis you can find it in much more detail in our Global Hydrogen Review, which is our flagship annual publication on hydrogen, and that we release every year, normally at the end of September or beginning of October. So, as you all may be aware, political momentum behind low emissions hydrogen remains really strong and is boosted by climate goals, the aim of enhancing energy security, but also lately by the adoption of new industrial strategies by several major economies in the world, in which hydrogen technologies play a key part. However, this strong momentum is still not turning into deployment. Hydrogen production remains almost completely dominated by unabated fossil fuels, although this could change if low emissions hydrogen production overcomes the cost barriers that it's facing today. We are seeing a growing number of announced projects for low-emission hydrogen production all around the world. And in addition, governments have started to make funding available to support the first large-scale projects, although the lengthy times between the announcement of the support scheme and the moment at which the funds are made available to project developers are delaying project execution. In addition, the cost challenges that I mentioned at the beginning have been exacerbated by inflation, which led to an increase in equipment and financial costs. On the demand side, the situation is more worrying. Government action has been focused on supporting low emissions hydrogen production, but measures to stimulate demand have only recently started to attract some policy attention. The private sector has also started moving to adopt low emission hydrogen through offtake agreements and also through some international cooperation initiatives, but efforts remain still at very small scale. So overall, we are still at a phase in which the adoption of low emission hydrogen as a clean industrial feedstock or as an energy vector is still at an early stage. And there is a need to identify those areas in which efforts need to be focused to turn this momentum that I mentioned at the beginning into real deployment. But well, let's start with some positive news, which come from electrolysis deployment. Installed water electrolysis capacity has been growing in the last few years, but from a very, very low base. Global installed capacity reached in 2023 1.3 gigawatts in what we think could have been a turning point for electrolysis deployment, since the global installed capacity nearly doubled compared with 2022. The outlook for 2030 looks much more impressive. Overall, a total capacity of around 14 gigawatts of electrolysis capacity is already committed, meaning that these projects are under construction or have taken a final investment decision, with China and Europe leading the developments. China actually has today 14 projects, about 100 megawatts of installed capacity under construction, or at least with a final investment decision taken, that could be operative in the course of the next year. Europe has a much larger number of projects committed, but with considerably smaller sizes, with some exceptions, such as the hybrid and the H2 green steel projects in Sweden, or the Holland hydrogen project in the Netherlands. And finally, in the Middle East, we observe a curious trend, which is a very small number of projects committed, only actually just a handful of them. But among them, we have the largest project in the world, which is the NEOM green hydrogen project in Saudi Arabia, which is already under construction. When we take into account also projects that are undergoing feasibility studies or that are at very early stages of development, such as concept projects, we see that if all those projects would be finalized and implemented on time, global installed capacity could reach 420 gigawatts by 2030. And also the pipeline of projects announced spans to a much wider geographical coverage. Europe still accounts for around a third of the total project pipeline, but projects are also developing in various parts of the world with good renewable resources. For example, Australia and Latin America account each of them for around a fifth of the total electrolysis pipeline, followed by Africa with around 10%. However, we need to realize that we are still far from materializing the full potential of the project pipeline, since those 14 gigawatts that I mentioned at the beginning that are committed account for only around 3% of the total capacity, and more than half of it is at very early stages of development, or what we can call concept stage. Electrolyzers, of course, are attracting massive interest, but they are not the only technology route to produce low emissions hydrogen. The use of fossil fuels with carbon capture, utilization, and storage can also play a significant role in scaling up the production of low emission hydrogen. Taking into account both production routes, annual production of low emission hydrogen could reach 38 million tons by 2030. And this is actually 50% larger than what we estimated when we published our Global Hydrogen Review in 2022. Of this total, around 27 million tons are based on electrolysis projects, and around 10%, around 10 million tons on projects using fossil fuels with CCUS. When we look at the geographical distribution of projects, we can observe some striking differences. Electrolysis projects have a bigger geographical diversity. I already mentioned it in the previous slide. But in the case of projects aiming to use fossil fuels with CCUS, they are much more concentrated, with North America alone accounting for half of the announcements and Europe for nearly 40%. In terms of maturity, electrolysis projects present a larger share of announcements are at early stages of development. I already mentioned more than half of the pipeline. But in the case of committed projects, both technology routes are in a very similar situation. In total, taking into account both routes, projects that have at least reached a final investment decision account for around 4% of the total production from announced projects. This may look small, and is indeed small when we compare it to the global pipeline, but it has actually doubled since last year, reaching nearly 2 million tons. This slow progress in project implementation is a consequence of barriers that are not unexpected. Actually, are barriers that we could expect in a sector that needs to build up complex value chains, such as uncertainty around demand, lack of clarity in regulations, lack of infrastructure, the infrastructure that is needed to deliver hydrogen to the end users, and some of these barriers which have actually been exacerbated by sluggish project implementation. I already mentioned the long timelines between announcement of the support schemes and where the funding is made available to project developers, but also due to inflation, which is the next topic in which I want to touch upon. Inflation has gripped the global economy since 2022 and has significantly increased the prices of equipment, but also interest rates on loans. And this has important implications for the economies of hydrogen projects. Some projects with feasibility studies that have been conducted before mid-2022 have had to rework their cost estimates and reevaluate their financial plans to accommodate the cost increases due to inflation. Several projects have revised their initial cost estimates upwards by up to 50%, with several factors being at play here. First, the cost of electrolyzers has increased significantly in the past few years due to the increases in materials and labor costs. The capital cost of an installed electrolyzer increased around 9% compared to the capital cost observed in 2021 in the last couple of years. Second, cost inflation has also impacted renewable electricity projects, the main electricity source for most electrolyzer projects under development around the world. Combine the two things, the higher cost of electrolyzers and the higher cost of electricity, of renewable electricity, led to a cost increase of around 20% for renewable hydrogen projects. However, the largest increase comes from the rise in the cost of capital. Capital-intensive renewable hydrogen projects are very sensitive to changes in financing costs. Just a 3 percentage point increase in the cost of capital rises today's levelized hydrogen production cost by nearly 1/3. This is most consequential in Europe and less consequential in China. But at the end, cost inflation is the pressing activity around investment activity all around the world. And the real challenge is that it increases significantly the gap between the available public support and the production cost. And consequently, public funds cannot be shared across as many projects as initially envisaged because financing needs for individual projects became larger. However, some good news is that this recent reversal in the trend towards lower cost of low emission hydrogen plants that we have observed in previous year is expected not to be permanent. And now cost is rising more slowly. In certain cases, some project developers have said that they have started to see the decrease in costs. And we think that the main impact will be delays to final investment decisions rather than cancellations. The other big barrier that I wanted to touch upon is demand creation. So as I mentioned at the beginning, based on announced projects, low emission hydrogen production could reach 38 million tons by 2030, which is quite in line with the sum of all the targets for low-emission hydrogen production that governments have adopted in recent years, which account for around 35 million tons. But the question is, who is going to absorb all this supply of low-emission hydrogen? Because without robust demand, producers for low-emission hydrogen will not secure sufficient off-takers and will not be able to underpin the large-scale investments that they need to materialize their projects, which jeopardizes the viability of the entire low-emission hydrogen industry. We have assessed the demand that can be created by meeting government plans, and we have seen that it's not sufficient to match their ambitions for low-emission hydrogen production. Around 7 million tons of demand can be created with policies that are today already in force, and this could be increased up to 14 million tons if targets for demand creation are met, but most of these targets are still not backed with concrete policies. In addition, only half of this demand is focused on existing hydrogen uses, which are better placed to adopt low-emission hydrogen in the near term. Governments and the private sector have launched several international cooperation initiatives to speed up the deployment of clean energy technologies, some of which are aiming to aggregate demand for low-emission hydrogen. But based on their commitments, they could create just between 1 and 3 million tons of demand by 2030. Moreover, the real impact of these pledges remains to be seen because these demand signals are still very unclear. An important observation, similar to the case of policies, is that these initiatives predominantly target new applications for hydrogen, and there is no dedicated coalition targeting the chemical or the refining sector. Finally, the private sector has also started to make some movements for the adoption of low-emissions hydrogen through offtake agreements, but most efforts remain at very small scale. Companies that have signed offtake agreements up to 2 million tons for low-emission hydrogen, although more than half of these offtake agreements are still preliminary agreements with non-binding conditions. And on this topic of demand creation, I would like to put the spotlight on the critical role that existing uses can play in scaling up with low-emissions hydrogen use. Switching to low-emission hydrogen in existing applications, mainly refining on the chemical sector, presents a much lower technology risk compared to new applications in heavy industry, in transport, or in power generation. This can be observed when we take a look at the production projects that have at least taken a final investment decision, more than half of which are linked with existing hydrogen applications, existing hydrogen uses, particularly ammonia production. The adoption of quotas or mandates for low-emission hydrogen use in refining, in ammonia production, in methanol production, can unlock very large amounts of demand and create the required economies of scale to bring down the cost of low-emission hydrogen. However, we cannot forget about the applications for hydrogen, those that are new applications for hydrogen, particularly those that are needed in a net zero future, such as steel, aviation, and shipping. Adoption in existing applications should be the first priority, but getting on track with climate ambitions require additional action on these new applications. Finally, I would like to finish with a brief explanation of the policy recommendations that we have outlined based on our analysis. First, on the government side, we think that there is a need to urgently implement support schemes for low-emission hydrogen production. Numerous supports have been announced, but in most cases, they are yet not implemented or the funds have not been made available to the project developers, which is hindering investment decisions. There is a need to take bolder action on stimulating demand creation, and particularly in existing hydrogen uses. Governments must take the lead and implement policies that encourage action on the private sector. There is a need to support project developers to maintain momentum during the inflationary period and to extend the regional reach. Governments can take actions with intervention to respond to these near-term financial risks that we are observing, with actions like loan guarantees or public equity investment in projects to help project developers that are struggling with increases in costs for equipment and capital. In addition, we think that there is very urgent for advanced economies to raise concessional finance beyond their initial recent commitments and support cooperation to facilitate the development of first-of-a-kind projects in emerging markets and developing economies. Finally, I want to highlight two recommendations that are not directly related to these presentations, but that we think that will be critical to enable the production and demand of low-emission hydrogen. First, that there is a need to quickly address regulatory barriers, particularly for project licensing and permitting, to minimize their impact on project lead times, particularly for infrastructure projects. And second, there is a need to foster international cooperation to accelerate solutions for hydrogen certification and mutual recognition of certificates, with the aim of allowing certain level of market and regulatory interoperability. We have also outlined some recommendations for the private sector. First, we think that there is a need to remain conscious that we are still at very early stages of the adoption. Therefore, it is the moment to work together to make sure that a market is created, and once it exists, it will be the moment to compete in it. Competing at this moment, where the mass market still does not exist, is harmful for all market players. Second, as I mentioned, all international cooperation activities initiatives are predominantly target new applications for hydrogen. We think that there is a need to create an initiative or a coalition to stimulate the adoption of low-emission hydrogen in existing applications, particularly in the chemical and refining sectors. And with that, I would like to thank you very much again for the attention and for the opportunity to participate in this webinar, and I remain available if there are any questions from the audience. Thank you very much.
Thank you, Ms. Jose, for your very insightful presentation on the global low-emission hydrogen market. IEA has been doing extensive analysis across the whole hydrogen value chain, and we do have some questions for you. The first question is really about the size of the market. What is IEA's projection for supply and demand dynamics by 2030? You mentioned some figures in your presentation, such as the 38 million tons announced production volume and the 420 gigawatt of plant capacity, but how much of them will be actually realized? And in particular, what's your focus on the demand volume?
Yeah, so indeed, when we mention those figures, we take into account all the projects that have been announced, but we have to remain realistic in that not all these projects are going to be realized, and probably only a small fraction of them. We know that at least 14 gigawatts are already committed, and we think that we are going to go way beyond those 14 gigawatts, which account for, as I mentioned, around 2 million tons. We think that this is going to go further because we have seen some policies that have been announced, and we really expect them to be implemented in the EU, in Japan, in the US, and also we are seeing a lot of activity in China. It's very difficult at this moment to make market projections because, as I mentioned, the market does not exist yet. So it's quite. I mean, it will be quite speculative to come with a number in terms of how much can actually be created. But I think that our assessment of existing policies really can give us a sense of what's the minimum that we can expect by 2030, which, as I mentioned, is around 7 million tons for low-emission hydrogen. I think this is what we can be really certain that is going to happen. And but still, we think that with the implementations of these policies that have been announced, and as we start seeing again cost decreases, probably we can go beyond that. Now, whether we can realize those 38 million tons that have been announced on the supply side, we think that there is a need of really much stronger action of what we are seeing so far.
And speaking of the cost, the LCOH, what are the expected trends in the cost outlook? And also, you mentioned a larger part of it is caused by the high cost of capital, the inflation. What's your recommendation for the industry to stay momentum during this challenging period?
Yes, well, as I mentioned, we are already start seeing some decrease in the cost of materials because some of the cost materials were not only a consequence of inflation, were also a consequence of tightness in the supply chains and some challenges in terms of supply chains that we are seeing now that they are a bit more relaxed. So we are expecting to go back into a trend of cost drop again in the short term. That's why we say that we still remain optimistic toward 2030. For the moment, we have to be realistic. Low emission hydrogen is going to remain way more expensive than unabated fossil-based alternatives. So there is still need for for actually to materialize the support that has been announced, for support schemes that have been announced by governments to try to cover this cost gap, and also to support and to stimulate potential demand. We have seen some support schemes being announced in the US or in the Netherlands, or some mandates. We think that this will help in create these economies of scale to help in decreasing the cost of production. In the different scenarios that we are seeing, we definitely expect significant cost decrease by 2030, mostly driven in the case of renewable hydrogen due to the decrease on renewable electricity costs, but also due to lower cost of electrolyzers, because we are seeing significant increase in the size of the manufacturing parts. So we think that there will be some regions in the world where today fossil supply is expensive because it has to be imported, and that have really good renewable resources, where low emission hydrogen could become competitive by the end of this decade. But this is not a general trend. It's a trend that we are observing only on certain regions, and we can name the case of the south of Europe or the case of Chile, where, as I mentioned, there's no cheap fossil fuels available on those regions, and depend a lot on imports.
Thank you. And this is actually a question from Adian Leah. He said, how soon do you expect the price coming down? I guess the answer is 2030 from your side.
Well, we think that costs are going to start dropping much earlier than 2030, but we think that 2030 is marking the horizon in which we can start seeing some competitiveness for low emission hydrogen with unabated fossil-based production.
And one last question before we let you go. Several questions we received in the Q&A box revolving around the policies. You mentioned the importance of taking further regulatory action to incentivize the production and use of low emission hydrogen. What is, in your view, the best support scheme that could be or has been implemented by a country?
So, I mean, this is very country specific in many cases. So what will be ideal for some countries may not be ideal for others, and we need to remain conscious of this. But we have outlined some policies that we think that can definitely help. So first of all, carbon pricing. This is a no-brainer. We really need to make sure that fossil-based production bears with the externalities of what it creates, and also, of course, removing subsidies for fossil fuels supply. These are two things that can be generally adopted everywhere around the world. But then more specific for hydrogen, we think that there are three main policy options that have to be taken into account. One is the adoption of quotas and mandates, particularly in sectors where hydrogen is the only alternative. And we can think about refining, we can think about ammonia production, methanol production. And this can be combined with quotas and mandates for low emission fuels in general, because there are other sectors in which hydrogen can compete with other fuels, such as shipping, aviation, or with other technology options, like in the case of steel. And then finally, there is a need also to provide certain support for demand, sorry, for potential buyers. So some kind of subsidies or support schemes that can help them in bearing with the additional cost of adopting low emission hydrogen instead of unabated fossil-based hydrogen or other fossil fuels when hydrogen is aiming to replace them. So there is a need to combine all these regulatory frameworks, regulatory alternatives, and support schemes to find the right balance, which, as I mentioned, is something that will be very country specific.
Thank you, Mr. Jose, for your response and for giving us an overview of the market description There are still like 5
Thank you very
questions
much.
in the class. I appreciate if you can stay longer and respond to these questions by typing.
Absolutely, I will try. Thank you very much, Molly, and all the best for the rest of the webinar.
Thank you, Jose. And next, let's explore the recent developments in the UK regarding the first hydrogen allocation round and the hydrogen production business model in general. Ms. Paro, Director of Hydrogen and Industrial Carbon Capture of the UK Department for Energy Security and Net Zero, will lead this session. And also, Ms. Paro will address questions following her presentation. Now, Ms. Paro, over to you.
Thank you, Molly, and really good to be here. Thank you for inviting me. Molly introduced me, so I'm not going to spend too long on introduction, but just to sort of give you a scope of what I cover, I'm responsible for the hydrogen policy and delivery in the Department of Energy Security and Net Zero. I cover policy development in hydrogen production, transport and storage of hydrogen, as well as the demand for hydrogen in the UK. I look at the different types of business models that we've got and the different ways of allocating those business models. And I'll be talking through that in this presentation. And the main things that I'm going to be focusing on today is about what the UK government has done in terms of driving the hydrogen strategy and the deployment of the hydrogen economy, as well as our first sort of successes in terms of the hydrogen production that's been allocated in the UK. So while I wait for Molly to put the slides up, and she's done that beautifully already, so if we can sort of move on to the next slide, then I can sort of give you a bit more of an idea about what exactly we are looking to do in the UK. So in the UK, we have set aside, we've put and we've published a lot of hydrogen production as well as demand ambitions. In the last slide, we talked about the fact that we published an ambition, which is looking at a hydrogen production of capacity of 10 gigawatts by 2030. And we've said that the role that hydrogen will play in the UK economy, we're looking to use hydrogen to decarbonize the various sectors of the economy that the IEA spoke about, but really kind of focusing in on industry, on power, on heavy transport, and really kind of thinking about the broader role that hydrogen can play in decarbonizing the UK. I think we always talk about hydrogen in the context of decarbonization, but in the UK, we can see the role that hydrogen will play in securing our energy supplies, as well as thinking about future jobs and growth. So we're hoping that with a developed hydrogen economy in the UK, we can unlock over 12,000 jobs and give the potential for £12 billion of private investment by 2030. So that's really what we want to get to. That's our prize. And let's just sort of talk about where we are now and how we are looking to get there. So this slide kind of gives you, the chart shows you the cumulative potential for low carbon hydrogen capacity in the UK. And this, I would say, is you can look at this as a pipeline in the UK. This is what industry tell us can be achieved. And that's primarily because of two things that industry often asks me for when I have the conversations with them. They say that we want from government long-term certainty. And we provided the long-term certainty in terms of the best kind of certainty there is, that is legal certainty. And we've passed the energy bill in the UK, which underpins the legislative framework for putting forward hydrogen as well as CCUS in the UK. And that includes, setting up the legislative framework around our long-term business models, but also putting forward the funding mechanism that's going to be supporting the hydrogen production delivery. So if we move to the next slide. Great. Okay, and then the slide after that. Thank you. So here, what I really want to kind of talk about is the main mechanism that we've got in place to have hydrogen production delivered in the UK. And the way that we're doing this is twofold. What the slide shows you is our long-term hydrogen production business model. But in addition to that, we've got a CapEx grant funding scheme, or the Net Zero Hydrogen Fund, which we're also kind of using to provide early stage development expenditure funding, as well as future hydrogen early CapEx funding to the sector. And what this hydrogen production business model does is it basically gives industry the long-term certainty to be able to produce hydrogen. This is a long-term revenue support funding mechanism. And what it's designed to do is it's going to close the gap between the cost of producing the hydrogen and the price that the hydrogen is sold for. It's done it through a contract for difference method. It's a variable payment that we offer, where we set a strike price and recognizing the price at which hydrogen can be sold in the market, we offer producers the difference between that, which is the subsidy payment that will come in from government. We've done this before, so the UK government has had a lot of experience in delivering a mechanism of this kind by using this as a way of delivering significant progress in offshore wind. And all of this is done through a common law contract. I spoke about the legal framework. What this legal framework does is it commits government as a credible counterparty to sign these long-term 15-year deals with industry to ensure that industry have a revenue certainty on the basis of which it can raise additional private sector financing if needed. And this is a way of unlocking the investment in the sector and ensuring that we get the right amount of hydrogen production that is happening. And remember that the UK has been always kind of agnostic about what kind of hydrogen that we produce. We want to be driven. We want the market to determine where the best hydrogen production lies. And the UK is very lucky in its geological abundance that we are able to deliver both carbon capture enabled hydrogen as well as hydrogen, electrolytic hydrogen. So we have got this funding mechanism is open to both types of hydrogen production, and we're also looking at alternative forms of hydrogen production which can qualify for this funding mechanism. So if you move to the next slide. Thank you. So this is so it's all very well to have a funding mechanism. It's all very well to have funds, but what we really need to do is to put that in action. So one of the things that we did in the UK is to announce hydrogen and electrolytic hydrogen allocation rounds. What we've said is every year we will be contracting for a set amount of production capacity. Last year, we contracted for, we announced an ambition to procure up to 250 megawatts. This year, we are looking to procure up to 870 megawatts and 875 megawatts. And we do this as part of something known as the hydrogen allocation round. So every year, we will be launching a hydrogen allocation round, and we would be looking to procure a set amount of capacity, which we will be supporting through these hydrogen hydrogen production business model contracts, these 15-year contracts that I mentioned. So I spoke about already this process to allocate green hydrogen with long-term subsidies. Let's talk about the outcome. So last year we committed to procure up to 250 megawatts of of hydrogen production capacity. We wanted to get to a co-funding aspect with them where we could get to final investment decision. We were successful in putting forward 11 projects. As you can see in the map, they are spread across the UK. And we awarded contracts to 125 megawatts. This comes with significant amounts of government funding, as your slides kind of point out. It's £2 billion of government investment, which supports £400 million of private sector investment in the sector. And we expect these projects to start delivering, to start be operational from 2025. And that is really important because what we have in our ambition to get to 10 gigawatts, we've got interim ambitions to allow us to chart a path to the 10 gigawatts by 2030. That is, by 2025, we want to get to at least 1 gigawatt of electrolytic and 1 gigawatt of CCUS-enabled hydrogen production in construction or in operation by then. And this outcome will help us deliver that. And if you move to the next slide. So obviously that was the first round of the hydrogen production allocation for green hydrogen, and we've already opened the next round. And recognizing that we weren't able to procure the 250 megawatts of hydrogen production capacity in the first round, we made the second round bigger. So the second round now is looking to procure 875 megawatts in total. That comes up to the total 1 gigawatt that I was talking about before in construction or in operation by 2025. And what we're really kind of looking to do is we want to make sure that we have got good projects, and we want to make sure that, subject to affordability and value for money of those projects, that we are able to procure up to 875 megawatts of hydrogen. The application window for this allocation round will close on the 19th of April 2024. So if you are thinking about putting in an application, now is the time to do that. If you move on to the next slide, please. Thank you. I think that is it for my slides. So really, I mean, today was just to give you an overview of what we are doing in terms of hydrogen production and how we are looking to scale up the UK hydrogen economy. And I'm very happy to answer any questions that you might have for me.
Thank you, Ms. Paro, for your very kind introduction and insights. In nascent stage of a market, public instruments serve as our principal interface with industry. By scrutinizing the advancement and hurdles associated with public instruments, we gain a deeper understanding of the industry's needs and pinpoints. The HAR1 is a significant first step towards the government's plan of 1 gigawatt of electrolysis by 2025. As of this moment, how affordable is green hydrogen at scale, given the price levels identified during HAR1? And how do you foresee the price evolution in the coming years?
I'm sorry, rookie mistake. I didn't unmute myself. Really good question. Thank you. So first of all, we have a competitive process in allocating our hydrogen production business model. We need to ensure that projects not only are value for money, but they're actually deliverable at scale. So we have a very robust process in which we're assessing each and every project as they come forward. We assess them on their merits, and then we decide to allocate the subsidy to them. And this robust and competitive process has helped us drive down costs, and it's pushed industry to optimize. As we said, we'll only award contracts to the best projects, to those that are value for money, affordable and deliverable. And this first hydrogen allocation round will end up unlocking about £4 million of private sector capital being invested in these products. And also we'll be able to we'll be able to sort of learn the lessons from these first hydrogen projects that are deployed in order for us to actually think about the final costs of the next set of successful projects in HAR2. And given the fact that we're really kind of focusing on subsidizing only the most sort of value for money deliverable projects, we hope to continue this process. In the long term, we want to make sure that we have an even more sort of competitive way of allocating our business models. Currently, it's a more bilateral process where we are assessing each and every project individually on their own merit by having bilateral negotiation decisions. But over the longer term, I mean, similar to how we've done in offshore wind, we want to get to a more competitive-based process to do that.
Thank you, Ms. Paro. Despite being an extraordinary scheme, the first round awarded only half of the planned capacity, as you mentioned. What do you see as the biggest production challenges?
Yeah, so I talked about our ambition quite a bit. I mean, we clearly have a published ambition to get to 1 gigawatt of hydrogen production capacity by 2025 in electrolytic hydrogen production. But we want to make sure that we've got good projects in construction and in operation. And this is the key, right? I mean, government has always said that it will allocate up to a certain amount, but we have always said that it has to be subject to value for money and affordability, as well as deliverability. We want to make sure that we are getting that bit of the supply curve, which not only does deliver the decarbonization that the projects themselves are promising that they'll do, but they will be on time and will also ensure that, you know, we need to make sure that we're getting the most cost-efficient projects, because all of this will feature into government subsidy, will have an impact on our taxpayer and consumer bills. So we want to, from a government perspective, we want to make sure that we're only getting the best projects. Recognizing that we didn't fully allocate our ambitious plan to get up to 250 megawatts in the first round, we have made the second round bigger because we want even better projects to come in, and we've actually got quite a lot of interest in the next round. So we are confident that we'll be able to do so.
Yes, the round 262 contract for up to 875 gigawatt of projects, a significant scale up from the first round. But some of the developers, they are worried. For example, as you can see from the Q&A box, they think it will be challenging for developers to beat the strike price of HAR1 in HAR2, especially without the CapEx support. Do you want to comment?
So we're very lucky because we've got a really good, healthy pipeline of developers who have expressed an interest in the second hydrogen round. I mean, obviously, I'm not going to go into detail as to how many projects have expressed an interest, because this is all very commercially confidential, but it points to a very, very healthy pipeline. And we've always been very clear on the process by which we're allocating these schemes. What we're seeing in evidence in terms of the pipeline actually points us towards being able to see good quality projects that are out there, which are able to meet some of the strict targets that we've put on industry. Because ultimately, this is a 15-year long duration subsidy contract. We want to make sure the government is confident that we're actually subsidizing good quality projects as well. While we expect the majority of the HAR2 projects to be electrolytic, it's actually quite interesting that we're seeing a lot of other projects, like, for example, gasification, pyrolysis, biomass, waste without CCUS, gas splitting, producing solid carbon hydrogen production. Those are also eligible for HAR2. So, you know, what we've tried to do, learning the lessons from HAR1, is open our pool to other types of technologies which might also be interested to participate. And we're getting a good interest in this round so far.
As the last question, wrapping up the UK session, can you provide us with more clarity on the plan for future allocation rounds, including details on the timelines and size, given we are eventually targeting 6 gigawatt of electrolytic hydrogen production capacity by 2030?
Thanks, Molly. So many of your readers would have hopefully, many of your listeners would have hopefully also seen that we have published something known as the Hydrogen Production Delivery Roadmap, which we published in December 2023. And alongside that, we published a call for evidence on our future hydrogen production rounds. And what it does is it sets out our government plans in terms of how we are going to be running the next few allocation rounds and what are the eligibility and the allocation requirements for them. And as I said, we are planning to run annual allocation rounds. We have said that we have already announced what the HAR2 allocation ambition is, up to 875 megawatts, subject to affordability and value for money. But we've also said that HAR3 and HAR4 will hopefully be able to deliver 1.5 gigawatts of capacity across both of the rounds. But all of this is subject to affordability and value for money. Again, sort of stressing that we really want to get those good quality projects which are able to be deliverable, which can come deliverable at the right time, at the right price as well. But also what we have said is that beyond that, beyond HAR4, we want to review this. We want to come back and see how industry is interacting with our HARs process, whether we are indeed being able to continually get a healthy pipeline. And it's great that industry is really responding to this. I mean, there's a lot of conversations that me and my team have with our industry partners, and we continue to get a lot of interest. If the evidence shows that future subsidy demands on government is actually, we are able to deliver better projects, showing the price discovery, showing the cost reductions on offer, then we might do a review and be able to increase the size of future rounds as well.
Thank you, Ms. Paro, for your generous sharing, and we look forward to hearing more good news from the UK side. Thank you for participating.
Thank you for inviting.
Thank you, Ms. Paro. And next, we welcome Ms. Rosalind Vandervlies, Director for Clean Planet at the Directorate General for Research and Innovation in the European Commission. Ms. Rosalind will deliver her keynote, Policy Accelerators for the EU Hydrogen Economy, Facilitating a Sustainable and a Secure Green Transition. Ms. Rosalind, the stage is now yours.
Thank you so much, Molly, and good afternoon, everyone. It's a real pleasure for me to be with you here today on this webinar on a very important topic, namely to finance the global hydrogen market. My name is Rosalinde van der Vlies, and I'm the Director for the Clean Planet in the Directorate General for Research and Innovation in the European Commission, based in Brussels. And in the next 10 minutes, I will guide you through the initiatives and actions of the European Union to accelerate the rollout of a hydrogen economy. And our President of the European Commission, Mrs. von der Leyen, in the State of the Union speech, she basically said that we want to roll out the hydrogen economy from niche to scale. So a very clear objective that we have with the European Commission to contribute to that. So if we start maybe, Molly, with the first slide, I would like to start actually with our overarching strategy that we have, which is the European Green Deal. And the European Green Deal has set a very clear direction for the European Union to move away from a fossil-based source of energy and to achieve a net zero economy by 2050. And our European Green Deal is not only our sustainability strategy, but it's also our competitiveness strategy and also our inclusive strategy, our social strategy for the European Union to leave no one behind in this pathway to climate neutrality. And we have basically translated this European Green Deal in the European Union into a set of regulatory frameworks or laws that support this transition. And also we have a lot of funding instruments in the European Union that is also supporting this transition. And it's clear that the transition requires significant efforts. So by reaching our 2030 climate and energy targets, it will require an additional investment of 260 billion euros per year. And it's very clear that not only the public sector can finance the cost of the transition, we also need to have the private sector on board. It's also clear that we do not have a lot of time. And that's why we believe that collaborative models where we are working closely together, both with the EU member states, but also with our industry, is really necessary in order to accelerate the transition. And developing this hydrogen economy from niche to scale in Europe and worldwide also requires huge investments in research and innovation. And we have been investing in hydrogen in the European Union in our research innovation programs already for the last 30 years. So I think we have basically, thanks to the fact that we are investing already for such a long period of time, a very good starting point now in order to roll out the hydrogen economy. And the European Union is leading on a lot of hydrogen technologies, notably on the production side, on the electrolyzers, but also hydrogen refueling stations and megawatt scale fuel cells. The flagship for our investments in research and innovation is the Clean Hydrogen Partnership. And here we have teamed up with the industry into a joint undertaking where both the European Commission and the private sector are joining together the efforts in a joint strategic research and innovation agenda and also in a joint investment plan. And the European Commission is investing in our Clean Hydrogen Partnership 1 billion euros, and this is matched by the private sector with equally available funds. So through this partnership, we are investing in research and innovation projects that are collaborative projects, bringing together companies in more than 3 EU member states. It's also open to companies that are from countries that are associated to the Horizon Europe program. And we are very pleased that also UK companies are very welcome to participate in our partnership since the UK has associated to the Horizon Europe program. So the the Hydrogen Partnership is covering research and innovation priorities across the whole value chain. So we're covering on the production, but also then the transportation of hydrogen, storage, and different end-use applications, ranging from the hard-to-abate industries to maritime policies and transport policies in general. A flagship initiative of the Clean Hydrogen Partnership are the so-called hydrogen valleys. And these are local industrial or transport clusters in a given geographical area where the renewable hydrogen is being produced locally and then also used in various end-use applications. The European Commission also has adopted a strategy to become independent from the import of Russian fossil fuels called our Repower EU plan. And as part of our Repower EU plan, our Clean Hydrogen Partnership has achieved a top-up of an additional 200 million euro in order to double the number of hydrogen valleys in the European Union. At this moment, we have already 23 of such hydrogen valleys across 11 EU member states. And there are many hydrogen valleys that are now ready to start with the implementation and actually production of the hydrogen and scaling up. We're also providing project development assistance to help the early stage valleys to mature to the point where they reach the final investment decision. And our inspirational target is to have at least 50 hydrogen valleys under construction or operation in the European Union by 2030. And we believe that such valleys are really a very important tool to accelerate the hydrogen economy. We are also working on a Hydrogen Valley roadmap in order to address challenges and barriers that the valleys are still facing in order to scale up their production, which we will publish later this year. So if we can go to the second slide, there I will really focus on how we are moving from research and development to further deployment. Because I spoke about the Clean Hydrogen Partnership, which is part of our program Horizon Europe for Research and Innovation. But through this partnership, we invest in solutions that are still at the pre-commercial deployment phase. And then we have another program called the Innovation Fund, which is funded through our emission trading scheme, which can take the research and innovation results to the commercial deployment. So this is one of the world's largest funding programs to move from the demonstration to commercialization. And to date, the Innovation Fund has already invested more than 1.5 billion euros in hydrogen-related products, including electrolyzers, but also green steel plants, and also focusing on ammonia and methanol. We also have a program that invests in the infrastructure, because it's very clear that in order to roll out the hydrogen economy, we also need to have the necessary infrastructure in place. And this we fund through our Connecting Europe facility, which has a total budget of more than 5 billion euro in order to roll out the infrastructure needed for the clean energy sector. We also work together with the European Union member states, and the member states are allowed to provide state aid to certain projects that are listed as important projects of common interest. And here we also have endorsed member states to provide this funding and state aid financing to 65 hydrogen-related projects. Lastly, I would like to point out a very important initiative that we have been taken together with the European Investment Bank and the Breakthrough Energy Catalyst, which is a private investment program created by Bill Gates. This is called the EU Catalyst Partnership, where we also have an opportunity to invest in hydrogen projects. And here we are really bringing together different financing sources. So through this EU Catalyst Partnership, we can combine grants with venture debt and equity. And I think this is really very important in order to cover the entire value chain, but also to make sure that we can provide funding and financing, not only for research and development, but then also for the deployment and commercialization. For us, as I mentioned before, it's very important to collaborate together with the industry. So apart from the Clean Hydrogen Partnership, where we work together on research and innovation projects, we also have established a Clean Hydrogen Alliance in the European Union, where we are bringing together the hydrogen industry across the entire value chain in order to address barriers that exist still to roll out the hydrogen economy, including the regulatory barriers, and where we are looking in development of pipeline of investment projects that can then also be taken forward at the national level. Lastly, I would like to mention the Hydrogen Bank, which is providing a green premium for the production of renewable hydrogen. It has been provided through an auction, and the fixed premium is paid per kilogram of renewable hydrogen produced. This is the latest novelty that we have put in place really to support the rollout of the hydrogen economy. The Hydrogen Bank launched its first auction in autumn last year, and we are close to selecting the final winners from this first auction. And then we will follow up later this year with a new call for people who want to participate in the second auction. So if we move to the next slide, just to point out that for us to realize the European hydrogen economy, we also need to go beyond the funding alone. And here we are really very focused on exploiting synergies between different instruments that exist, both at the EU level, but then also at the national level and international level. Here I would like to highlight in particular the Strategic Energy Technology Plan, or the SET plan, which is a key instrument to bring all the relevant players around the table. Through the set plan, we as a European Commission are collaborating with the member states, but also with relevant stakeholders in the industry, in academia, and within the set plan, we have a dedicated group that works on hydrogen. And here we are really combining the industry efforts with the efforts from the academia and the national efforts in order to develop and deploy low carbon technologies in a fast and cost competitive way. And then lastly, maybe a quick word on skills, because it's of course very important as part of the rollout of the hydrogen economy that there is a sufficiently skilled workforce to accompany this transition. And therefore we kicked off our first European Hydrogen Academy in January of this year. And it focuses on university type courses, retraining, upskilling, and also a network of schools to really prepare also the next generation of workers for the hydrogen economy. So to conclude, the European Union has come a long way when it comes to clean hydrogen. As I mentioned, we already started investing in hydrogen solutions through our European research and innovation programs more than 30 years ago. And it's clear that our European Green Deal ambitions require a multitude of solutions, and hydrogen plays a very important role. It's a very important instrument, if you want, or tool in our toolbox. We are investing across the entire hydrogen value chain with a big focus, of course, on hydrogen valleys to really roll out the hydrogen economy at the local level. And at the same time, and I think that will also be for the future, a specific focus on the hard to abate sectors, so steel, cement, chemical industries. And we are really very, very happy to collaborate. And we believe that it's very important to bring together the policymakers that are also responsible for the laws, the regulations that are in place, the public funders, and also bringing them together with the private investors and with the industry themselves. So I would like to conclude by really pointing out 3 opportunities for collaboration. First, I mentioned the work of the Clean Hydrogen Partnership. The Clean Hydrogen Partnership publishes work programs with calls to which consortia of potential beneficiaries can subscribe. And as I mentioned, since UK joined Horizon Europe program, UK entities are invited to join these consortia. The second opportunity is the next auction of the Hydrogen Bank, focusing on renewable energy production with a fixed premium per kilogram there. And lastly, and this is more at the global level, I would also like to draw the attention that the European Commission is co-leading at international level the Clean Hydrogen Mission under Mission Innovation, which is bringing together 23 countries globally across the world. And in the Clean Hydrogen Mission, the ambition is to collaborate across the globe to bring down the costs of the hydrogen production, to make it really cost competitive with alternative solutions, and also there to work on hydrogen valleys and roll out hydrogen valleys across the globe. So Molly, I would like to stop here and very happy to start the Q&A session. Thank you.
Thank you, Ms. Rosling, for your gracious address. The EU hydrogen market is catching the world's attention, and the directive's work indeed paves way for a future successful EU market. Let's first talk about the Hydrogen Valley, which is featured prominently in your presentation. A dedicated Hydrogen Valley roadmap will be released later this year. Can you give us some hints on how it will be structured and implemented? For example, its technology framework, investment volume, etc.
Yeah, thank you, Molly. So for us, this roadmap indeed is a very important next step because we really want to address all the barriers that currently exist in our economy to accelerate the rollout of the hydrogen valleys in Europe. So it will cover different aspects. It has various building blocks. The first building block is that it's focusing on the R&I needs that we still have for the future. And there I mentioned, for example, the reduction of costs which is still a very important priority for us when it comes to the hydrogen production, but also to reduce our dependencies on certain critical raw materials. So we will be looking on how we can collaborate in order to increase the circularity and recyclability. Then, apart from the R&I needs, we will be looking into the regulatory framework. We have set in place at the European level a really supportive regulatory framework to roll out the hydrogen economy, including with production targets. So we want to produce 30 million tons of hydrogen in the European Union locally, so inside the EU by 2030, and also import a similar amount. So we also have set a target to import 30 million tons of hydrogen into the European Union. But we hear a lot of stories where still at the national level, there are a lot of regulatory barriers that exist in order to roll out the hydrogen valleys in the hydrogen economy, which range from really strict prohibitions to set up a production site, to also, for instance, time lags in the granting of permits. So we really are encouraging our EU governments to work with what we call regulatory sandboxes. And regulatory sandboxes should really be there to create kind of like a safe space for example, a hydrogen valley to really accelerate with the starting of the production of the hydrogen in this given geographical area. Then the third building block is that we will be looking into the investments, and in particular how we can attract additional private investments to these hydrogen valley projects. So really de-risking them and attracting the private sector there. And finally, we will also be focusing on education and skills. And as I mentioned, also the global cooperation, so the link with mission innovation.
Thank you, Ms. Rosaline. As you mentioned, regulatory assistance is crucial apart from the funding support. And you mean for Hydrogen Valley projects, you will be giving like green lights or project highway in aspects like streamlining the permitting process and expediting the approvals for projects. Am I correct?
Absolutely, yes.
Mm-hmm. And also, the commercial operation is critically important for valley projects to reach future scalability. When do you foresee such program achieving commercial operation and covering its upfront investment costs?
Yes, so through the programs that we currently have, we support demonstration projects, large-scale demonstration projects that will be replicable also in other parts of the European Union. And then we will be supporting the companies into making their projects bankable. This we do through a program of project development assistance, where we are also very closely working together with the European Investment Bank and really supporting these projects in translating them into a bankable project. Because sometimes we really feel that the investors, the private investors, they speak a different language from the projects that we have been supporting in the pre-commercial stage. So it's really very important to bridge this gap from the research and development stage and the first of a kind large-scale demonstration projects to really this fully commercial operations. And there the project development assistance in our experience is really very, very important in order to support the companies to bridge this gap and to attract then the private investors that are needed to scale up the hydrogen project.
Thank you so much, Ms. Rosaline, for your very insightful address. There are still a lot of questions waiting in the Q&A box, but we don't have time to address them all. Once again, thank you for your participation in today's Impact webinar, and I would appreciate if you can stay longer to address these questions.
Yes, I will do it in writing in the Q&A. Thank you so much, Molly. Pleasure.
Thank you. And next, let's shift our focus to Germany's groundbreaking H2 Global mechanism. Please join me in welcoming Mr. Timo Bollerhey, CEO and Managing Director of HINCO and H2 Global Advisory. Mr. Timo, over to you.
Very good afternoon to everybody. So I'm delighted to be here with you this afternoon. Hi, Molly. I'm not sure. Do I share the screen or do you share the screen?
Yes, Mr. Timo, I would appreciate you sharing the screen.
Okay, very good. Then let me just introduce you the HC Global model, the HC Global instrument, and how it also compares to other instruments within the European Union, but also maybe on a global perspective, and what is the innovative or the new approach that we are taking with the HC Global. Just trying to share the screen quickly. So I hope you can see the right screen now. This is sometimes always the confusion.
We can see it.
The full screen, okay, very good. HC Global is an instrument trying to grasp the hydrogen opportunity, or to make the ambitions and the opportunity to turn that into reality. And it helps, I think it's might have already been said during the course of this day, where we are at the moment. And actually, sometimes we're talking about the market myth when it comes to hydrogen, because there is no real market yet that is really functioning. So we just look at a few numbers. We see that globally, it's a very positive number. Close to 500 gigawatt of electrolyzer capacity has been announced until 2030. This is positive because it's nearly double the size of the governmental targets and all the hydrogen strategies that have been issued so far. So this is a positive sign. The private sector is actually ahead of the public sector. However, this 500 gigawatt is still far below what is required to be on the Paris path and the net zero path that we all anticipate to be. And now the reality kicks in. Around 120 gigawatt is what expected by Roland Berger, a consultancy firm, to be really in place and implemented by 2030. So a tremendous gap to the ambitious targets set by the industry, by the governments, and far below what is required to be on the Paris list. And if we look at the current situation, below 1 gigawatt is actually installed as we speak, and only below 5 gigawatt is globally under construction. So we can see that this is still quite a way ahead we have if we want to reach our climate goals. Also, if we look at the number of projects, I think, Molly, you also mentioned in your introduction, there's a huge number, a big number of projects being announced every day, 1,400 globally, according to the World Hydrogen Council. We see MOUs being signed every day. But if we look what is really happening, FIDs, because that is really from talking going into action, they will only have around 98 FIDs being closed, and around only of the clean projects, around 4 to 5% have actually reached FID. Another interesting element is when we look at the investment requirements that is needed. We're talking about a $4 trillion global investment requirement just for the production of clean hydrogen in the next 12 to 15 years. This is quite a significant number. Against that, there is 100 billion of public funds being made available in all OECD countries, including China, in the next couple of years. So this really shows we only have a very limited amount of public funds to stimulate the investment into those $4 trillion that is needed as an investment requirement. Now that leads to the conclusion that we actually need to tap into the vast sea of institutional capital, around $100 trillion being invested every year. And we need to allow that institutional capital to provide the funding and the investments that are required to build up the hydrogen economy. So what does capital mean and need? What does it require? It requires a functioning market. And a market requires transparency, requires liquidity, it has to be clear rules that are set out, and it needs to be barrier and entry fee. This is what is required for the institutional funding to really enter and deploy the funds to invest into the hydrogen economy going forward. In the reality at the moment, there is hardly any price transparency. It's a tap in the dark. Indexes that are already out there, they're mainly assumption-based. If there are any trades in terms of liquidity, they're very limited, and all OTC point-to-point contracts are not really creating liquidity into the markets. There's still a huge leeway to go in terms of standards and certification schemes. There's a huge insecurity, lots of talk. I think it is very positive. Also now in Europe with the RED II delegated acts being in place, you can argue about the details, but it's good that we have them in place. We're urgently waiting now for the voluntary schemes to come in, but then we also need to take this to a global level, international recognition of certification schemes. There is still some leeway to go. And we have, with all the issues that I mentioned above, we've got quite significant high entry barriers going into that kind of markets. So instead of talking about a market ramp up, we should actually talk about the market creation in the first place that is really then ramping up. And Berger mentioned it, they call it the roaring 30s. They assume that it will be only really taking place, that market ramp up in the roaring 30s, and we need to create now the right basis for that market to be created. Also, we could call it the green commodities, the offtake conundrum with green hydrogen. I think most people is very clear. The production costs for clean or green hydrogen are significantly higher than a fossil-based energy carrier or grey hydrogen. The gap, anything, I don't know, between 4 to 10 times, depending which research you read. We assume that the production cost with scalability is going to decrease in the next couple of years, decades. Also now with the price developments in recent times, we will see whether that's going to be straight line or if they're even going up. We need to see that, but however, in that situation with decreasing cost assumptions, nobody would start to invest, especially if there's no off-taker, because nobody's paying that price gap, as you speak. And in top, we also assume that the willingness of the markets to pay a green premium or higher price for a fossil-free or a green product will increase depending on CO2 taxes being installed, CO2 pricing, border taxes, quotas being introduced. That all will have an impact on the willingness of the market to pay for a green premium. In that situation, as we speak, we have got the classical chicken and egg situation. Nobody's starting to invest because no, there's no offtake. Nobody's taking off because there's no really affordable molecules in the market, and that is where we stand at this point in time on the supply side, but also on the demand side. Things are not really moving. Everybody is eager to waiting for the right moment, signing MOUs, but not really getting to FIDs. And that is where we try to come in with the H2 Global mechanism to bridge that situation that we have at the moment. These are the price curves that we just seen. Normally when the curves would meet, this is when the real market creation, the market ramp up will take place. What we try to do is shifting that market creation forward in time by simulating more or less an existing market on the supply side and on the demand side. And we do that in a very specific way by introducing an intermediary. We call it the HINCO, the hydrogen intermediary company, in between the supply and the demand side. And we want to achieve a couple of things. First of all, we want to bridge that insecurity that we have. So we want to provide the supply side with long-term offtake agreements, providing price security and volume security, providing clear definitions and standards that we require for it. And with that long-term offtake agreement with a bankable offtaker, this is exactly what is required on the supply side to go to the investors, to the banks, to reach FID, to have bankability and really get into FID and into production. This is what we want to provide on the supply side to get the system rolling. And we wanted to have a very defined system for the governments, defined in terms of volumes, in terms of tenor. It should always be the governments in the driver's seat, providing the cost of difference element that I'll explain later, providing the government funds exactly to the terms and conditions that they require. The core element is, as I said, that intermediary HINCO, and it's a sort of a cost of difference approach we have here, but a little bit with a different tweak. And it's also very important that we wanted to have a very competitive approach by introducing a dual auction or a dual auction element, an auction on the supply side and on the demand side. So if we look at that graph here, you can see that HINCO is really a physical intermediary. So it's not a pure matchmaker. It really is a contractual partner on the supply and on the demand side. So HINCO is signing the contracts with each side. And HINCO at the end of the day is nothing else than a trader, but a very unusual trader. Some people might call it a stupid trader because HINCO is doing a very unusual thing. It buys expensive and sells most likely much cheaper. And that difference between the purchase and the sales price, that is being covered for by public subsidy. We do this, as I said, in a very competitive manner by having an auction on the supply side. First round of auctions I'll explain later. A global auction, obviously the aim is here to buy as cheap as possible and providing the 10-year offtake agreements, fixed terms, providing that investment security and investment case. On the demand side, also auction Obviously, the highest bidder will get the strike, so that the cost that needs to be compensated for by the government is kept at a minimum. But on the demand side, we do a different thing. We're only selling at the short end with 1-year contracts, and we do that for 2 very specific reasons. The first reason is that we assume that in the beginning of the lifespan of the long-term offtake agreement on the supply side, that's that horizontal line on top, there will be quite a significant gap that needs to be compensated for by the government, because we will only achieve maybe a little green premium above a gray price. But with the developments in CO2 price and border taxes, etc., pp., we assume that the willingness to pay for a green alternative will rise in the market. And through the yearly auctions, we allow Hinke to benefit from a higher income from the sales auctions, which then obviously minimizes the cost of difference that needs to be covered for by the government. That really ensures that only that much subsidies flowing into the system that is really required to overcome that gap. You could argue why you're not using a normal CFD system here. The issue with the classical CFD system is you need reference prices that are reliable. And as we heard, there are no reference prices at the moment. So we are creating these reference prices through the yearly auctions. And this is exactly the second important aspect why we're having these short-ended auctions in the current scheme, because we do price discovery, which we make very transparent to the market, so that producers, if they know in Europe the off-takers are willing to pay, I'm just giving a number, €8 a kilogram for hydrogen, then they can do their own assessment, am I in the money, am I out the money, and they can do the evaluation there. Also, other support schemes, we've just been in discussion also with the German Klimaschutzverträge, how we could utilize also the price signals recovered under the HG Global schemes to also supply pricing signals to other subsidy schemes going forward. So price detection is a very important aspect. Liquidity creation, because we're also not only supplying large-scale off-takers, also medium-scale off-takers in Europe. So this is a very important point where we are creating liquidity, pricing signals, exactly these 2 essential ingredients to create markets going forward. I mentioned at the beginning, HG Global is a very flexible instrument and a very steerable instrument for the government. It's always the provider of the funds that determines exactly how the funds should be utilized. For example, in the first round of auctions, the BMWK in Germany decided to have a global auction production taking place outside of Europe, importing into Europe. They defined which product should be supplied. In this term, we are talking about ammonia, methane, ESAF. Also, they required additional sustainability criteria that exceeding even the European delegated acts as we speak. And the governments can try to achieve different targets, price optimization, promoting specific technologies, or energy policy aspects, for example, when it comes to diversification of supply chains for the energy supply. I think a very important topic in Europe and especially in Germany after the developments that we've seen in Russia into the Ukraine. We received for the first global window 900 million by the German government. We are just in preparation for the next round of auctions where we received 3.5 billion by the German government. The next window might be different geographies, maybe even a regional diversification, also including potentially European production and offtake. And we can also sign country-specific funding windows. We call it the window logic. Thereof, we just signed 2 MOUs already, one with the UAE, and just on Monday, together with Minister Wilkinson and Minister Habeck from Germany, a German-Canadian funding window in the vicinity of 400 million euros that should be deployed. So it's a very flexible instrument. You can have single import windows like Germany is doing now. We're also preparing now the first joint import window. This is also already a little referring to the so-called import leg of the European Hydrogen Bank, where member states join forces, the Dutch government, the Netherlands, and the German governments each provide 300 million for a so-called joint window. So they are pooling the funds to cover the cost of difference, and Hinke would then import into Europe, into Germany, and into Netherlands. You could do the same what we've just been signing now with Canada going forward, which is very interesting because due to the fact that this is not a non-compliant WTO export subsidy, you can also pool funds from exporting countries and importing countries in Europe to cover the funds for the cost of difference that need to be covered through. So it's a very flexible and steerable instrument going forward. I just mentioned already there's quite an international interest in the model so far, which really took us by surprise. As mentioned already, the import leg of the European Hydrogen Bank, there has been an understanding between Commissioner Simpson and Minister Habeck that they did in terms of setting up joint windows in discussions with Austria and Belgium to set up similar windows like we're doing over the Netherlands. We just signed, as I said, a joint window, an MOU between the governments, between Canada and Germany to set up a joint window. Same has been already conducted at the COP28 with the UAE. There are ongoing discussions with Australia on doing the same. And just this morning, we have a collaboration just started with the Japanese government. Also, how the instrument or the approach of the double auction could be maybe become a potential part of the Japanese auctions going forward. Maybe just a very last word on the setup of H2 Global. When I developed HINTCO and H2 Global, I thought HINTCO is a state-owned entity. The government made it very clear, the German government, right in the beginning, we don't want a state-owned entity here. We want this to be run privately by the private sector and independent from the government, but however, also independent from the private sector. So this gave us a little bit of a headache because how's the private sector able to run its own options utilizing public schemes, public funds here? And we managed to do that by implementing or creating the H2 Global, a non-for-profit foundation. By now, we have over 67 funding members, donors from all over Europe, all over that are supporting the H2 Global Foundation. And the H2 Global Foundation is sort of the mother of HINTCO, which is that intermediary that I mentioned. And HINTCO is also the recipient of the governmental funds. And with the foundation as an intermediate layer between the donors, which are purely donors, and HINTCO, we ensured that there's absolute independence from governments and the industry of HINTCO. And the foundation itself belongs to nobody, it only belongs to himself, and not to the governments or not to the industry, as we speak. Without further ado, that was a very first introduction to H2 Global, and I'm looking forward to the discussions.
Thank you, Ms. Timo, for your very insightful presentation. H2 Global is indeed an essential approach to support hydrogen demand buildup, and we wish to dive deeper into its design. If I may, on page 7 of your slides, you provided us with a trend chart indicating the convergence of supply and demand prices at a certain point in time. When do you anticipate this convergence to occur? And considering the purchase agreement for the buyer side, for the seller side, is set for a 10-year term, is a decade an optimistic or positive timeframe in Germany's perspective?
I think this is the million-dollar question. When do we have price parity between demand and supply? So honestly, I think it really depends how fast we get our act together now. We need to be full throttle. In Europe, I think we need to stop talking about should we import, should we produce locally. I think we really need to really get our act together to start now with real projects as soon as possible. I would assume there will be different commodities having different timescales here. I think ammonia and maybe ESAF will be. We need to see ESAF, yeah, but ammonia, I think it's got the likelihood that it will first have that price parity. We need to see now so how expensive is really in terms of utilizing hydrogen as a pure molecule when it comes to cracking or other vectors like LHC. Also very important is when do we receive the first pipeline bound imports of hydrogen. I think this will be a very big game changer once we really have the significant volumes also being able to deliver it. I think this will be somewhere in the beginning of the 30s, I would assume.
And also, managing the demand market is a key component for the mechanism to succeed. On page 10, you mentioned that on the demand side, the highest bidder wins. But how can we ensure that the demand price consistently trends upward? You mentioned some factors like carbon pricing, taxes, quotas, etc. Any more mechanism will support the buyer's willingness?
I think this is the regulator. I think there's a little bit of back echo here. This is very much by the regulatory environment that we see. I think really if CO2 pricing has become really a burden for fossil-based industry, the more attractive a green alternative will be. It really depends on also how we link infrastructure together also with the pure molecule and the production of green hydrogen. I think the infrastructure discussion is taking up speed and pace as we speak, because it's very important. We also need the right infrastructure in terms of terminals, in terms of crackers, in terms of storage, in terms of backbones. All that needs to be developed simultaneously in order to create the demand as well. We need to have the right infrastructure in place also for the demand side, which is not maybe directly linked to any harbor, to be able to switch production and to change the commodities.
Yes, and the last question for you. Many of the questions we received are revolving around H2 Global's first round auction. How's the progress? Any key lessons, major challenges, or areas of optimism observed?
Yeah, I think we are lagging, if you want to say, 7 months or 6 months behind. Our plan was actually that we would announce the first winner in Q3, Q4, or Q3 last year. We extended the timeline of the tender for, I think, 5 times. So the lessons learned here is that there is quite a significant difference between, let's say, project outline and really signing a binding 10-year contract, because also what we're doing here is different to other support schemes. What we are really signing is a 10-year offtake contract between HIMCO and the supply side. So this is the revised HPA that the bidders are bidding on now. Is a nearly 100-page contract with all the nitty-gritty details that you require for such kind of contract. It's not the pure subsidy that HIMCO is providing, and the actual players, stakeholders, they are then in the aftermath signing and developing those contracts forward. So this was just for us very clear that was one of the insights that we received, that the market takes longer. It's not where we expected it to be. Projects take longer to really come to the position to sign those contracts. So this is something which is one of our key takeaways going forward, that we just have to be aware that the markets require more time than maybe anticipated.
Thank you so much, Ms. Timo, for sharing with us the updates of H2 Global, and we look forward to more optimism from your side in the coming months.
Thank you.
Thank you. And next, we embark on the second chapter, Igniting Commercial Confidence. First up, let's welcome Mr. Amir Sharifi, Chief Investment Officer of Hy24, to give us the keynote on scaling private investment to hit the 320 billion hydrogen market. Mr. Amir, the floor is now yours.
Hi, everyone, and thanks for the introduction. I'm very pleased to be now ready to speak after such enlightening presentations. I think today my purpose will be to give an update on on figures and on investments. We have heard the last two presentations were about regulations done by Rosaline and one just before on the H2 global scheme. So here I think my goal will be to give you a bit of an update on how to actually see the market happening in terms of investments and where it's going to happen, in which verticals it is going to happen. So to do this, I need to share my screen. I'm just looking to where I should do it. Can you just point me to where I should do that?
Yes, Ms. Amir, you can just press sharing the screen.
Yes. So I will start and I will find it, I think, on the way. So just maybe as a kind of background introduction on the reason why it matters to look at hydrogen as a source of so as a solution to the energy transition. Let's just keep one figure in mind, which is that today 80% of the global energy mix is still reliant on fossils, and 20% are produced by alternative sources of energy. And amongst those, we have nuclear, we have wind and solar, of course, hydropower. But ultimately, wind and solar only represent 5% of that mix, and that's what we actually show on slide number 2. The point is that if we want to decarbonize at big scale the energy mix, effectively, what is required is to multiply by 2 the worldwide electricity consumption by 2050. But so it means in practice to electrify many of the applications, but it's not sufficient to electrify. This electrification needs to be green or clean. And we know that, I mean, developing new nuclear capacity is either controversial or very expensive or very long. We know that developing new dams for hydropower is, in many of the cases, either impossible for land or permitting matters. And so, in fact, it's really about developing wind and solar at major scale. And the figure is 650 gigawatt of wind and solar capacity to be installed every year by 2030, which is a multiplication by 4 of the current pace. That also entails a major investment challenge, because that would imply that we need to deploy 4 trillion of investments, which is 5 times more than the current pace. And of course, we need to be more energy efficient. So if we look at the next slide, we understand that effectively the reason why this 650 gigawatt of wind and solar, the only reason why this can happen is that we need to solve for what the wind and solar cannot really do. The intrinsic issues that they behold. The first one is the integration with the grid, because they are intermittent sources of power. The second is the fact that the locations where you can produce energy renewable energy at the bigger scale are far away from the places where demand is actually located. There is a bit of a saturation of the land space in Europe and in Asia or in Americas, where you have most of the demand, whilst the locations where you have the most opportunity and the biggest locations to harness wind and solar power are effectively in the deserts, coastal deserts, which you can find in the Middle East, in Australia, or in south of Chile, or maybe even north of Europe or north of America. But those regions tend to be far away, and you can't really put a grid to connect those locations one to another. There's too much degradation, there's too many issues, and we know that the Desertec project failed, especially exactly for that reason. So actually hydrogen is the way to reconcile those massive production locations with massive consumption areas. And finally, there are just simply areas where power is not a solution, and you need to decarbonize using a fuel, the so-called hard-to-abate sectors, which are basically in the refining, in the chemicals, in the fuels, in the steel, in the heat industry. All those decarbonization applications require usually already are consuming hydrogen, and so the fact is that you need to convert that gray source of hydrogen to a green source of hydrogen. So hydrogen is basically a solution that brings flexibility because it's an energy vector that can be stored and that you can move energy with. So it gives you access to the most resource abundant places. It allows to manage intermittency. It reduces the strains on the electricity grid. And so effectively, it's not the only, but one of the unavoidable levers to the energy transition. So just to, I think all of you are aware of this, but I think it was worthwhile to remind it. And then the translation that we are showing on the next slide in terms of what it means in terms of the figures is that the demand for hydrogen is going to be multiplied by a factor of 7 from 90 million tons today to 700 million tons in 2050. But the fact is that today this 90 million tons are produced from a gray source. So actually you need to replace that gray hydrogen with green. That's already an 80 million tons that need to happen by 2030. And then you need to do another big step towards the demand that is 20 to 20% of the global energy demand by 2050. It's a major challenge in terms of amount, and it's also a major opportunity because it will require very heavy investments. It means that the whole value chain will need to happen. So that's what we're showing on the left. It's not just about production, it's about end use, it's about infrastructure, and it's about manufacturing capacity. So the context is that we need to invest into the full value chain a bit at the same time in order to make the whole hydrogen economy happen. And so what figures are we talking about in the next, by 2030, just to make it concrete? On the next slide, we have actually shown the magnitude of the direct hydrogen investment that need to happen. So, you know, the title of the presentation is hitting the 320 billion target. So here the figure is coming from the Hydrogen Council. You can see it on the right of the slide. 2023, 320 billion direct hydrogen investments need to happen, or at least have been announced and are at different stages. So if you accumulate that figures, you get to that 320. That's just as a reference, an increase of 34% versus last year. I want to highlight that figure of 34% increase because let's remember that we are in the context of a bit of a credit crunch. The interest rates have massively increased. There is much less liquidity in the market. Inflation has been soaring. So everything has become more complicated. And against this backdrop, we can still see a massive increase of the number of projects that are either happening or that are being developed. So I think this is a very encouraging sign. And I think there are not that many industries that are on an upward trend in this challenging environment. The second figure I'd like to point to is that the FID plus column, so the projects which are at final investment decision stage or under construction or operational, already represent 30 billion investments. It's not a negligible figure. I mean, let's remember that this hydrogen framework has just been started a few years ago, as was reminded by Rosalind before. So I think that effectively having such a big amount of investment already at a stage where things are being decided is a very encouraging sign. And this has been highly supported by either some very early regulations like the IPCEI, which is the support that has been brought by the European level on the important projects that have been getting a derogation to the state aid and have been getting specific support to be kicking off. So these were critical into establishing the first projects. And the other ones are even happening without any kind of aid. is basically like if you take the case of Saudi Arabia with the NEOM project, or if you take the case of H2 Green Steel, you have some of those major projects which are already under construction, not benefiting from direct subsidies, but more from either a political willingness or a market context where people are ready to buy that green molecule, even if it's more expensive than alternatives, because there is a market behind it. And we'll get back to that right after. And then you can see that just behind those FID projects represent 30 billion, there are 40 billion lining up of projects which are at detailed engineering stage. So this will go, I mean, a portion of those will go to FID stage, and it's just piling up every year. So every time I speak about those figures with people that tell me it's nothing's happening, it's slow, etc. Well, I think it is of course taking time, because making an investment decision is not something you do just out of the air. You need to have contracts, you need to have done the engineering, you need to have done the studies, etc. But in fact, there have been 30 billion projects which have gone through that stage and that are already there. And there's a big lineup of projects which are also going to get there. And all of this, if we look at the next slide, is effectively supported by an extensive policy landscape. So I will not be spending too much time on that, because there was a presentation by the EU just before. So, but just as a synthetic view of all those regulations, at least the ones that we have been really cautious about. First one, there is the Renewable Energy Directive, which has been very important and pretty recent that we have got the clear rules as part of delegated act enacted. So now we have these Renewable Energy Directive. There is actually an obligation for a minimum consumption of renewable energy in transport, in industry, or in cooling sectors. So that is very important, because it's not a matter of matching a gap in price. It's a matter of you have an obligation as an industrial company to decarbonize. So effectively, if you are under this obligation, the price will less be of the concern. You'll just need to abide by that. And so the transposition in the French scheme under the TRR, for instance, has been pretty efficient in getting the refiner companies deciding to sign, or at least to get into the process of running tenders to find projects which will be providing them alternatives from gray to green hydrogen. And we're also seeing this in Spain or in Denmark, where effectively the switch from gray to green is really the driver. Then you have the Refuel EU Aviation, which is a strong signal, because again, it's an obligation to have a mix of your fuel. If you're an airline company with EU located airports, you need to have a portion of SAF, Sustainable Aviation Fuel, or ESAF, which is the synthetic version of it that is produced through hydrogen, in your mix. So this is going to drive a lot of demand, massive demand, much more than what is going to be available for production. So again, the price is not the concern. Same goes for Refuel EU Maritime. And then you have other drivers like the CO2 standards for cars, which impose greenhouse gas emission standards. So this is going to also put pressure on the manufacturers of cars and vans to go for it. And we know that maybe for light duty vehicles, hydrogen is not always the best solution, but we also know that for heavy duty vehicles, this can be a much better solution. And for vans or for captive fleets, it is really the way forward is hydrogen. And this is also why the alternative fuel infrastructure regulation, which is going to impose to have every 200 kilometers 2 stations with capacity of 1 ton per day. This will drive also demand, because the member countries will need to invest in that infrastructure. They will need to be vehicles to be refueled in those stations, and so this is going to drive demand, and so this is going to help drive production. And then we go back to the Renewable Energy Directive, which is helping that production. So I'll skip the next slide, which is giving more details on this, and just go directly on page 8, because this one shows you that on top of those kind of regulations, which are the ones that tell you about what is and kind of push on demand side, there is on top of this a number of contracts for different programs that are coming into effect at different dates with different ambitions. I mean, our take is that the figures are too small in comparison with the size of the industry, but at the same time, if you put yourself in the shoes of the regulators, they need to see this happening. So they start with smaller kind of allocations, and then it will grow. But those CFDs will be critical because they complement the existing schemes where effectively it's a demand push. It's a way for production to feel comfortable that there will be a client that will be ready to buy, even if there is a price difference. The price difference will be gapped. The gap will be bridged. And then if we look at the next slide, this was for the Europe picture, but it's not just about Europe, it's also about all what is happening in Asia and Americas. So we have large ambition in South Korea to foster the industry. In Japan, there is a contract for a different scheme. In Australia, there is a subsidy program for hydrogen production. In the US, there is the so-called and very famous IRA rule, which is very simple, very efficient, $3 per kilo of hydrogen produced. So very efficient scheme is just being debated, and we'll see what's the final outcome in terms of the rules of the game to be part of it. And Canada is also released a first draft of tax credit legislation. So all those drivers in other countries in the world are effectively pushing for the hydrogen economy to boost. And so this is helping the whole industry to kick off. And as I was just mentioning before, if you look at the next slide, beyond those policy push, there is a push from disruptive players that are actually in the game already today to do projects at very large scale. So you can look at the projects of NEOM and H2 Green Steel on page 10. And the other big driver of projects to happen are the politically driven projects. There is an Oman strategy, for instance. They have set up a specific entity to manage the concessions, Hydrom, and they have a specific production target of renewable and hydrogen. So those hydrogen strategies at country level or the European hydrogen backbone are things which will also be major enablers at large scale of the whole hydrogen economy to happen, because these are disruptive, these are large scale, these are massive investments, and they're driving the whole ecosystem into things happening. So I've been like setting the scene for all this happening, but then people will tell me, okay, so there is a great scene on the regulatory side, there is major players and political will. So why is it not happening even faster than what is happening today? Well, the answer is in the next slide. The issue is that there is a lot of money in the world available for the energy transition, massive amounts. If you just take the amount managed by the sovereign wealth funds, is $500 billion. If you take the figures managed by the insurance companies and pension funds, it's trillions that they have under management. In fact, and they are willing to invest into green. The issue is that their mandate, which is a kind of more cautious risk return, low risk, low return type of mandate, doesn't really fit with a sector where at the beginning you have a risk, intrinsic risk linked to the market. The market doesn't really fully exist today. It's not like the power market where you have liquidity. So if you're producing that molecule, are you sure that there's going to be a client down the road? And are you going to invest into a developer that will be developing projects if down the road there's not the demand? So it's a bit of the always chicken and egg issue that we always hear about hydrogen. But the thing is that regulation is helping to bridge the gap, but also you need money to accompany the projects. And the very fact is that the reason for our fund, the Hy24 fund, that to be created and us as a fund manager to have been established as a pure play for hydrogen is simply because we have realized that all those allocations of money from the large pension funds is difficult to allocate today to a kind of immature industry. So apart from a few specific cases, like we have seen before. So for the whole the tens or hundreds of other projects that are happening everywhere in the world, you need actually a fund mandate that is properly designed is the way forward. And this is how we have actually structured our fund value mandate, is to basically understand and agree with our investors that it is early stage infrastructure, that there is going to be at the beginning negative cash flows and cash flows going into development with development risk, but that with the merit of having a diversified exposure, you actually mitigate a lot of that risk, because not all of the projects will be delayed at the same time. and not everything will go wrong at the same time in the same location. So diversification is one of the main drivers, but also the fact that there is a huge leverage effect, because when we raise a 2 billion fund, in fact, we can deploy 20 billion because we're going to raise debt, we're going to raise equity from other investors and subsidies. So this is why we have been setting up a dedicated vehicle, and we can see at the next slide how we have been organizing ourselves to do it. We have been actually setting up a dedicated fund manager, which is called High24, which is a joint venture between Argin, which is today one of the largest European fund managers in the world of private equity assets, with $160 billion on the management. And on the other side, 5T Hydrogen, which is basically a group of the best hydrogen experts in the world, including the former head of hydrogen at Air Liquide, Pierre-Etienne Franc, with which we have been creating that joint venture in 2021. And also we have been not only having this approach of we are a financial fund, because we are actually a hybrid fund with competences from people who come from the industry and understand hydrogen, and people who come from the asset management side. But this also reflects in our LP base, in our investor base. So you can see on the left that you have number of industrial groups in our investor base, which gives us a lot of comfort and a lot of value add, because these players, they can bring offtake, they can bring understanding on technological challenges, they can bring understanding of where regulation is moving at a certain pace, they can bring certain projects in which they want us to co-invest. So there is a huge merit of having 50% of our client base, which is actually industrial. And that is a very unique feature. There are not that many funds who do it. So with all those ingredients, we have been actually able to raise a fund that is investing in the full value chain, as you can see on the next slide. Our idea is that we don't focus just on production and wait for the subsidies to be there. We also invest in the downstream and the midstream, because this is where we're going to generate demand also happening. So we're a bit solving the issue of the chicken and the egg, because with a fund, effectively investing both on the production, but also on the demand mobility downstream usage, we are kind of creating it and benefiting from the diversification effect to mitigate the risk of demand taking time to happen. This is what was shown on slide 13, where you can see the schematic of all the projects where they're happening. And so to conclude my presentation, I would like to show you on page 14 why and where we have been investing in certain verticals and how we have been able to do it. And the background is that it is a very difficult investment space by definition, because the regulations and the demand is not fully there at the scale we would expect. But there are some very interesting regulatory drivers that help us get comfortable on certain key verticals. So the first one is the Renewable Energy Directive that we talked about, which is clearly pushing demand from industrial players who want to switch from gray to green. So people who are already using hydrogen as a feedstock for a refinery process, or green ammonia as a feedstock for the fertilizer process, this is clearly an area where it's a bit of a no-brainer. You just switch from one to another, but you need to find that green source of power behind it. And so you need to find, to reduce the price gap with the gray, you need to find the best locations in terms of production of power, of green power. And in Europe, we have identified that this is happening in the Nordics, and this is happening in Spain. So that's why we took a position with Enagas Enagas Renovables, which is a developer of projects of renewable projects in Spain, and with Everfuel in the Nordics. So that's basically a very simple and clear way to answer and leverage on the Renewable Energy Directive. The second one is that there is a big push on refuel with the Refuel EU Aviation and Refuel EU Maritime to decarbonize e-fuels and sustainable aviation fuels and methanol for maritime. And so we have decided to make an investment into a dedicated player located in France that has access to CO2 sources, also access to French low carbon nuclear electricity. The combination of both give them a very strong case for producing e-fuels at a competitive cost, relative speaking, because effectively the cost is just one component, but more importantly, to have CO2 resources that will enable them to have a significant available capacity of production, and that is already ready to sign offtakes from companies on the shipping and on the aviation side, because they're in 2025 the regulation is kicking off, and they need to have 2% of that sustainable aviation fuels or maritime fuels. Then the third play is around downstream applications, and one regulation that has been very, very helpful is the carbon border adjustment mechanism and the fade out of the ETS 1 and 2 that is actually helping green steel that is produced with low carbon intensity to be not only competitive versus gray, but also seeing that off-takers are ready to sign contracts with a premium, a green premium, versus the traditional way of producing steel, because the CO2 price is rising, and there is this carbon border adjustment mechanism that is actually creating bridging the gap of the cost price. So this is actually very helpful for our H2 Green Steel project, which is a fully integrated project between hydrogen production with a very cheap hydropower source in Sweden, access to iron ore, and the site, which is best in class and technology state of the art. And the second one is H2 mobility, where we're relying on the regulations I mentioned before on mobility. And the last one is the fact that we have national import strategies coming from Asia in particular, like Korea or Japan, and also from Germany and other countries, where actually they need to import large amounts of ammonia because this will be a source of decarbonization for their industries. And again, we discussed that before. If you have a developer in Oman or in Australia, which is the case for intercontinental energy, or if you have access to a hydropower source in Norway, you can access to a very cheap source of power, and therefore be very competitive in terms of providing either hydrogen or either ammonia as a source as a vector of hydrogen and decarbonized energy to the final consumer in those countries where they need to decarbonize at big scale, and they don't really have any other available options. So this has been the way we have built our portfolio so far. We continue to deploy it, but we have already made 7 investments. And this is a bit what I want to tell you today, is that effectively the hydrogen industry is moving. There are pathways and specific verticals where it makes sense to invest even today. And in fact, in a couple of years from now, there will be the regulations kicking in. And in fact, having locked in the first mover positions in the developers is going to be a key advantage, because then everyone's going to be willing to follow. But we will have kind of a step ahead, because we will have seen the issues. We will have locked the best locations. We have discussed with the off-takers. So that gives us one step ahead. And I think I'm encouraging the players and the people in this call to consider moving into the space in a more aggressive way, because effectively it's just a matter of getting things done and invested. So that's it for me.
Thank you, Ms. Amir, for your very comprehensive sharing and for sending the positive signals to the market. We have 2 main questions for you, and because we are really running late, so I hope these questions can be short and clear. The first question is really about the capital flow. So a lot of saying that the funds are a lot of funding seems to flow to the tech development like Series A and B, and little to project DevEx. Do you want to comment? And also, while the investment increases by $79 billion in past year, but the participation of private financing sector seems slow. What's your think on that part, and what's your take?
The answer was in the earlier slides. So I think the fact is that there is a lot of available money to invest into green transition, but there is very little money that is kind of available to be invested into the development stage. And this is a bit where we have decided to take to play the game, because that's where actually you can lock the first mover advantage. And that's also why you need certain competences, you need a fund, because that creates diversification and expertise. So all of this kind of makes the case for doing it. But I agree that it's challenging for a large pension fund to think that they will be following tens of developers, which one to choose, which windmill project will work. It's a very heavy process of selection, of follow. So I agree. And then to the second point of the question, the investments into the tech is also very important. There is a very big gap between the amount of money that is actually needed for the manufacturing side of things versus the demand for it. If you look at the sheer size of the industry and the infrastructure project that will be built, there is a huge gap. And actually, it was the last slide I didn't show, but there is 100 times more equipment needed than actually what is currently being produced. So there is a huge opportunity of investments. And actually, we have set up a separate fund to invest into the manufacturing side, because this is also one of the bottlenecks for all the projects to happen once the infrastructures will be going to construction stage, which is not so far away from now.
Thank you, Ms. Amir, for your very kind address and for joining us today. Thank you.
Thank you.
And following the overall investment outlook, let's delve into green ammonia contracting. Green ammonia is considered as an early adopter of hydrogen carriers with huge potential to decarbonize various industries. And now, please join me in welcoming Mr. Joe Moser, Chief Executive Officer of First Ammonia. Mr. Joe, the stage is now.
Thank you, Molly. May I ask you to put up the slides, and I'll ask you to advance them as we move forward. So let's have the first slide, please.
Yes, we are working on it.
Thank you.
Appreciate your patience for 30 seconds.
That's okay. Well, I'll just, here we go. Lovely. And great. Let's move to the next one. Okay, so just a word about who we are, just to get started and introduce ourselves to this group. We're an American company. I know much of this conversation has focused on Europe and the UK, but as you'll hear in a moment, we have very significant ties to Europe. But just in brief, we are a company that's been established around several core principles in no particular order. Modularity. We set out to develop a modular design for commercial scale plants to make green ammonia. And just a word about ammonia as opposed to the larger industry of hydrogen. I don't think I need to explain to this group the role that ammonia will play in the hydrogen economy. We chose our name to double down on our principal thesis that ammonia will be the facilitator of the hydrogen economy. There will, of course, be lots of applications for pure hydrogen directly in industry. Ammonia will be among and we believe the lead carrier of hydrogen as hydrogen, but we're committed to ammonia as our product. So modular commercial scale plants, which can go anywhere in the world, and we have sites around the world, in the United States, in Europe, in South America, indeed in Africa even, and in Asia, in various stages of production. A second principle is intermittent production. Intermittent because if we're going to be connected to renewable power, which is an intermittent power source as our principal feedstock besides water, of course, we needed to be able to operate intermittently. And in fact, we are starting to use the term fluctuating because under the 45E regulations that we'll be operating under our first site in the United States, hourly matching suggests a fluctuating operating profile as opposed to a intermittent on and off. I think we'll be on most of the time, but operating at a fluctuating capacity based upon the hourly matched power. Another principle that we established as part of our core operating mission is to develop our sites around Topsoe SOEC electrolyzers. We have a partnership with Topsoe for 5 gigawatts of electrolyzer capacity. We believe the SOECs will be the way that hydrogen will be produced. Currently and into the future, the most efficient form of electrolyzers. So we have committed to Topsoe's SOECs, and we'll discuss that in a moment. As I mentioned before, we have sites around the world, approximately 20 sites we expect to be in operation by 2030. With the first site in Victoria, Texas, there's a photograph of me with our Houston-based Director of Development, Lee Raymond. Next slide, please, Molly. So a word about Topsoe, which is our technology partner, our principal relationship and a major touchstone of our European connection. Here we have a photo of the cornerstone unveiling at Topsoe's Herning plant, a landmark project to build solid oxide electrolyzer cells in Herning, Denmark. That's Roland Bond, the CEO of Topsoe, Jacob Topsoe, the Danish energy minister, the mayor of Herning. That's me standing there with Kim Hedegaard, the CEO of Topsoe Power to X. That plant, that photo was taken in May. That plant is essentially built now. We'll be producing 500 megawatts of capacity of SOECs a year. Topsoe is an amazing company, and indeed, not only will they be our SOEC electrolyzer supplier, they've done our feed, and they will be producing and supplying us ammonia loop module. So next slide, please. Thank you, Molly. So as you can see from the photo, we have more than a couple of at least European connections between Topsoe and Uniper, the German power utility, which is our off-taker for our first site. A few other European connections, which I'm not yet able to talk about publicly, but we have selected Victoria, Texas for our first site for a couple of reasons. Earlier panelists have talked about the need to be connected to abundant and low-cost renewable power, and the United States, at least parts of the United States, are such a location that, and there's a spine in the US starting around the Gulf Coast in Texas and running northward, where there is abundant, inexpensive renewable power. Policies by the United States will continue to lead to the development of additional vast renewable power resources. So it is geographically a great place to produce a hydrogen product. In addition, of course, the passage of the IRA draft regulations finally came out around Christmas time last year, and hopefully the final regs will be issued shortly. Of course, confirms the US as a great site, a cost-effective site to produce hydrogen and its products. So the photograph here on the left is the dock along the Victoria Barge Canal that's connected to our site, where we'll be producing up to 500 megawatts. We'd speak in terms of megawatts of production of ammonia. Each 100 megawatts at nameplate produces about 100,000 metric tons of ammonia. We won't be operating at nameplate because we'll be operating on a fluctuating basis, but most of that 100,000 metric tons will be produced per 100 megawatts. And we announced in October in Berlin at that photo, I promise that's the last photo of me on this slide deck, that our off-taker for that site will be Uniper. Train 1 will be operational in 2026, and I know my topic is offtake, but I'm sorry to say I can't say anything specifically about this offtake agreement I'm under NDA. It is a private agreement, but I will speak about offtakes in general, which is the topic that our hosts asked me to address. So on the next slide and the slides to follow, we have a series of questions that our hosts asked me to comment on. We see this is the Ammonia tugboat rather, which could run a barge, of course, to pull ammonia, which is to run on a ammonia powered fuel cell. Another great American company based at the Brooklyn Navy Yard. So what is the green ammonia contracting status quo? It's obvious, and others have said this, it's early days, it's early stage. I don't know that one even can articulate that there is a status quo so much as a series of projects moving forward on their own track. The previous panelists talked about several which they are backing. Ours is on a different track. I don't know that there's any generalization one can make other than we're all finding our way forward in a new market. Next slide, please. Are green ammonia contracts adopting elements of traditional commodity procurement? Well, the first comment I want to make about that is that I think it's early to describe green ammonia as a commodity. I mean, of course, NH3 is a commodity. There's no difference in any particular molecule as opposed to another. And there's a commodity market for conventional ammonia that's existed for decades. And certainly at volume, green ammonia will be a commodity. It will be a different commodity than conventional ammonia, given its characteristics as having been produced using electricity as opposed to natural gas. But there aren't enough green ammonia projects in operation. In fact, none. There are no commercial scale green ammonia projects in operation. There are several in development, as the last panelist slide has shown. So I think it's early to talk about it as a commodity. And I think it's early to predict the way that its contract process will take place. Others have said, and I don't disagree, that it's perhaps going to evolve the way the LNG market evolved, from a few early projects negotiating bespoke contracts to a robust commodity traded market. And that is likely, but I think it's early to have a sense of that. Next slide, please. What are the critical factors for drafting the contract? Price, tenor, or risk sharing? Well, the answer is yes. By the way, that's a barge in the photo that's parked at our dock in Puerto Victoria. Ammonia will move around, in my opinion, primarily by barges initially until it gets to a transfer point where it's able to be put on ocean-going vessels if that's where it's intended to go. But look, price is, of course, key. It drives economics, it drives financing. Tenor, as well, as one of the earlier panelists talked about. Contract terms need to be long enough to put financing together. These projects, even by some of the largest companies with very significant balance sheet capacity, are at this stage of the game being developed on a project finance model, meaning that it is the contract which drives the project economics. So tenor is important, longer the better. But again, if you relate that comment or that question about tenor back to the question about commodity, a commodity market has its contours and predictability, at least within some parameters, about price. And though there are those who can predict that or try to predict it, can hedge that. that doesn't exist with a new market. So the only way that an investor, and particularly a risk-averse lender, can become comfortable with the project economics is with an offtake agreement of some substantial tenor. And then finally on risk sharing, yes, absolutely. I think this is a time in the market that anyone who's participating in a project is going to have to be part of the conversation about risk allocation in a classic project finance sense to get a project to FID, so that participants can feel comfortable that we'll get built, will operate, and we'll have a successful offtake. Next slide, please. What can the industry do to set expectations? And then separately, could there be open source term sheets as in the gas industry? Well, there are a few mechanisms, H2 Global and others that we've talked about, very impressive programs, particularly in Europe and in the UK, others perhaps evolving in Asia. The US, of course, came forward with a distinctly American version of a subsidy in a tax code provision around the IRA. But I want to challenge or question the use of the term industry. I don't think there is a hydrogen industry, let alone a green ammonia industry yet. There are several industries. So there is a chemical industry. There's a fertilizer industry as part of the agricultural industry. There's a shipping industry. And there's a power industry and many others, all of which have some interests in green hydrogen and specifically green ammonia. We hear from major companies from all of those industries. And that's what's driving this production. That's what's driving the development of green ammonia projects. It is not my view that these various disparate industrial interests have combined yet to form a singular industry around green hydrogen or green ammonia. That is to come. As far as open source term sheets, as in the gas industry, we are a few years away from that. I think that we're talking at this stage, certainly from my perspective, bespoke term sheets, bespoke offtake agreements. I think open source term sheets, as in the gas industry, are something that are to come when we can start to talk about green ammonia as being a commodity. So next slide, please. What is next for contracting and commercialization? Are we waiting for the top 20 projects to set the standard? Let me just make a comment, sort of an anecdote about being in the elevator in my building. Our offices of our headquarters is in New York. We actually have offices in Copenhagen, Berlin, and as I mentioned earlier, in Houston as well. But our headquarters is in New York, which is, of course, very finance industry intensive. And someone in the elevator saw that I was coming from the floor, First Ammonia, and asked about us and then said, "Can I trade that as a future yet?" Well, the answer is not yet, but that's what's coming. And that's what's coming when we are a commodity, when we are an industry. But I think this question answers itself. I don't know whether it's 20 projects or 10 projects or 30 projects, but the projects, and as the last speaker from Hi24 said, the projects that are under development now are the ones that will set the track, the path for the industry. The projects under development now are the building the, creating the trail, breaking the trail, and will very much shape how this industry emerges. It is very much now project finance based. I think when there are, whether it's 10 or 20 or 50 projects producing this project, I think it moves on to be, as was asked before, a commodity. Perhaps we'll be able to graduate from project finance-based capital to the way commodity projects are developed and financed. And yes, I think that's a matter of time. I don't think it's a lot of time. I think we're growing very quickly, as some of the previous panelists have said. And I think that, one might even say it's sort of the hockey stick kind of growth curve. So with that, I think that's my last slide, and I'm ready for questions.
Thank you, Ms. Zhou, for your very kind address that has already touched on, I think, basically most of the questions we received, leaving only 2 left. And the first question is really about the price signals. How do you foresee the clean ammonia market prices look like pre-2030 and post-2030?
Well, as a company that will be producing green ammonia, no one would be shocked to hear me being bullish about the price forecast. But I will say this, that if you look at the drivers of demand, going into the future from the marine transportation industry as ships start to sail, from the power industry as turbine generators are converted to pure ammonia generation, in terms of hydrogen pipelines, which will be connected to ammonia crackers, you see demand that is much more robust than the production that the early projects are capable of. And therefore, you have this situation that one of my co-founders, who's an economist, hates me saying. So we'll say, though, nonetheless, demand will outstrip supply. Of course, that's impossible because supply and demand meet at a price. Okay, what will be that price? I'm going to put out a number. I think by 2030, it's going to be $2,000 a metric ton. There's no magic. I don't have a metric which gets me that point. But I will tell you that in a situation where there's much more robust demand than production, that price is going to have to go up.
Thank you for your very generous answer. But now only a few long-term renewable ammonia contracts have been signed. What do you think are the main reasons, and what's your suggestion? Maybe you can keep the answer short.
Sure. There are only a few projects that are actually moving forward. And it's early days for the off-takers. So it shouldn't come as any surprise to anybody that only a few contracts have happened. It's the very beginning of an industry.
Thank you, Joe, for your insights and for joining us today. Thank you so much.
You're welcome.
Now we come to our last keynote before the panel discussion, delving into the realm of scaling finance. What is the World Bank's take on scaling hydrogen finance for hydrogen development in emerging economies? Please join me in welcoming Ms. Carolina Rocha, lead author of the World Bank Scaling Finance Report. Carolina, the stage is now yours.
Thank you very much, Molly. I will be sharing my presentation. And please let me know if you can see it.
Thank you, Carolina. Yes, we can see it.
Okay. So good afternoon to everyone in Europe and good morning to everyone in the Americas. My name is Carolina Lopez Rocha and I'm an energy regulatory specialist at the World Bank. The World Bank is a multilateral development bank that provides concessional financing to governments. And since 2020, we have been working with emerging markets and developing countries to implement their hydrogen objectives. In this session, I would like to share a presentation that has been developed with 3 main focus. The first one is that we will be discussing what are the key issues and risks that are affecting bankability and preventing projects from achieving FID in emerging markets. The second point that we will be discussing is the specific examples on how the World Bank Group is de-risking those projects. And finally, I will be providing a snapshot of the 10 gigawatt lighthouse initiative that is leading the World Bank. So as you will see in this slide, it provides a context of the role of clean hydrogen in emerging markets and developing countries. So in the report, Scaling Hydrogen Financing for Development, the World Bank calculated that to achieve the net zero commitments in 2050, the world will have to produce 40 million tons of clean hydrogen by 2030. And this represents a big opportunity for emerging markets, as half of this hydrogen will be produced in the global south. But it is also a challenge, because in order to produce 20 million tons of clean hydrogen, developing countries need 700 billion of hydrogen investments between now and 2030. And that represents an annual financing need of 100 billion per year, and a financing gap of $10 to $40 billion. So in this context, we also need to acknowledge that hydrogen projects require high levels of capital, and that this bulkiness is really an issue that needs to be addressed. And here you can see it in this rule of thumb. So for 1 million tons of green hydrogen that has to be produced, we will have to install 10 gigawatt of electrolyzers, 20 gigawatt of renewables, and the whole investment would go up to $30 billion. So this represents that there will be several challenges that are faced for clean hydrogen projects to be evaluated under bankability. And in this slide, you can see that there are several aspects. Some of them go towards the high cost, but also others related to the technology and even to the general lending environment. And also it is relevant to say that what we are seeing is very aligned with what our prior panelists shared, is that most of the hydrogen projects will be to produce green ammonia. And at the World Bank, we did an analysis. We had a market sounding with over 50 financiers and developers around the world to identify what were really the key risks hindering the availability of financing. So we were able to map 6 risks that are the most important one to tackle if we really want these projects to achieve FID. And we can divide them in 2 groups. The first group is those risks that are inherent to investing in emerging markets, regardless of the infrastructure of type of project that there is. So that is political and regulatory risk, which encompasses sometimes the lack of a transparent regulatory framework or the ensurance of the rule of law. The second is the challenges to obtaining permits, and that is specifically for those environmental and social permits that are needed to start the construction of these projects, and also some macroeconomic aspects such as the high interest rate. The second type of group is those that are specific to hydrogen projects, and that we can have the offtake agreement, which also, as prior panelists mentioned, it is critical to secure that these projects have final investment decision. Then also the enabling infrastructure. And here we believe that the World Bank can play a substantive role in developing countries, because the common user infrastructure is something that governments might need to cover if they really want to achieve the full potential of the hydrogen economy. And finally, also, this is a nascent technology. So at the levels of the projects that we are seeing that are over 50 megawatt, there is no track record. So that also poses a risk on how the technology will be operating for large scale projects. In this slide, you can see that the risks that we discussed before can really impact the cost of the project, as high risks normally reflect in a high weighted average cost of capital. And here you can see that, for instance, countries in Africa that have excellent solar renewable capacities but have very high weighted average cost of capital, around 15%, really makes it much more bigger, the total project cost, and also takes away the competitiveness in the levelized cost of hydrogen. The same in Latin America, where we have excellent solar and wind, but also due to the risks, the weighted average cost of capital goes between 10 to 13, also taking away the competitiveness. And it is just in high-income countries where the risk is less perceived by financiers, and therefore the cost would be less. And in this next slide, we see also that beyond the cost of capital, in developing countries and emerging markets, the cost of renewable electricity and the high capex of the electrolyzer are also affecting the bankability of the projects. So if we really want to reduce the total project cost, we need to tackle these issues, de-risk the projects, but also secure that the cost of renewable electricity is competitive, and that the cost of the capital expenses of the electrolyzer goes down. And this challenging situation and risks actually have an impact. In this slide, you can see that the announced projects by stage as of May 2023 has been really stagnant in emerging markets and developing countries. So in terms of investment, you can see here that developing countries and emerging markets have almost 90% of the share of investment just in very early stages, which are announcements and pre-feasibility studies. And if we go to the share of investments in more advanced stages, such as front-end engineering and final investment decision, it's only 10%. And that is quite shocking if we really want to comply with these net zero commitments by 2050. So we need to give a step forward and help these projects achieve bankability. So as of January of 2024, there were only 6 renewable hydrogen projects that are large scale, over 100 megawatts, that have achieved final investment decision in emerging markets and developing countries. So 3 are in China and 3 are outside China, in India, Vietnam, and Saudi Arabia. And the ones that are outside China is to produce green ammonia. So what are we doing at the World Bank Group to support these projects achieve bankability and also mobilize private sector investors? So as the World Bank Group, we work with the government within the IBRD and IDA. So we are developing regulations with the governments, but also providing grants and concessional finance for governments to implement those projects. And in the private arm of the group, which is the IFC and MIGA, they are heavily working on upstream project support, also providing grants and concessional financing, and making available political risk insurance. And we have developed a methodology or some criteria that are essential for projects to be able to be eligible to access the funds of the World Bank Group. And there are 4 key issues that we are evaluating. First of all, we need to make sure that these projects have attractive offtake arrangements and that they will be also the products will have a certain market. So we are evaluating whether there are export markets that are willing to consume the hydrogen or its derivatives from developing countries, but also in those countries that have large domestic industries that can be decarbonized. For instance, we're evaluating India and Brazil. The second aspect that we also evaluate is the sponsor strength. So it is extremely relevant that whenever these projects are presented, there is a track record of the financial and technical strengths of the sponsors. They can have a track record in renewable electricity or in related infrastructure projects, because that really gives certainty of the capabilities of these actors. The third, of course, is the public policies. So we are targeting countries where they have policies and regulations that enable the investments, that we evaluate what are the subsidies, tax credits, concessional funds available, but also related to the renewable energy cost. So we want to evaluate whether there are the possibility of having private PPAs, or if the regulation allows for energy banking and wheeling. And the fourth point is, of course, availability of enabling infrastructure. We have seen over and over that it is critical to have power, ports, roads already available to be able to develop these large-scale clean hydrogen projects in developing countries. And here I would like to share with you some real-life examples of what is the pipeline of lending that we have. This is lending that is provided to the governments. So the first two in Chile and India were already approved last June of 2023, and they sum up over $1.5 billion. And the use of this concessional lending has been to finance electrolyzer capex, and also to develop risk mitigation instruments, and also to support the development of policies and regulations to enable the hydrogen economy. And we are currently preparing also lending operations with Mauritania and Brazil. And here we will be focusing on common user infrastructure. In this slide, you can see specifically how is that these financing mechanisms are structured. So in the left side, you can see Chile, and here we have an electrolyzer focus. So when we were discussing with the key actors in Chile of what were the barriers that were hindering the investments, what we received from investors and developers was that there was extremely high capex for the electrolyzers, and they not necessarily had the access to financing for this capex. And also they were concerned about the performance of the technology in large scale projects. So what we did is that we developed a lending operation of $150 million from the World Bank, and in collaboration with other multilateral development banks, including KfW, the European Investment Bank, and the Inter-American Development Bank, we put together over $1 billion, and we put it in a green hydrogen facility, which is an intermediary that will pass on the concessionality from the World Bank and the other MDBs to the private sector projects. And those will be benefiting in terms of interest rate, tenor, and also modalities of repayment. And the money will be used for two main aspects. The first one is to provide a concessional lending line for the electrolyzer. And the second will be the risk mitigation instruments, so that in case the technology is not working properly or the KPIs of the project are not met, these risk mitigation instruments will be triggered and can provide cash flows for the project. And on the left side, you can see the second type of model that we are using at the bank, which is to finance shared green hydrogen infrastructure. So specifically in PECEM, in Ceará, in Brazil, what we are doing is that we will be financing a specific infrastructure for generation and storage that will be used by all the companies that will be producing clean hydrogen and its derivatives. And I would like to finish this presentation with what is coming next from the World Bank. So we are proposing the 10 gigawatt Lighthouse initiative. And this initiative aims to align the different financial institutions that are currently working in clean hydrogen. And we have acknowledged that no single multilateral development bank or private bank will be able to tackle and fulfill the financial needs of this new industry. So what we aim is to coordinate the efforts and debottleneck those projects in emerging markets and developing countries that can achieve final investment decision by 2030. So with that, we aim also to tackle large-scale projects that are over 100 megawatt to a 1 gigawatt scale. And we believe that with that, also, we can show that the technology will be function and decrease later on the risks. We will be making sure that all this information is being shared so that all the best practices can be replicated, the business models, the contracts, the type of financing, and that it will be accessible for the actors in this industry. And we hope that different DFIs, African Development Bank, European Investment Bank, etc., can join, but also private sector investors. So thank you very much, and back to Molly.
Thank you, Ms. Carolina, for your very insightful address and the well-structured presentation. It basically covered all the questions we have prepared. And I noticed there are still some detailed questions in the Q&A box, so we don't have time to address them live. I would appreciate if you can stay longer and try to answer these questions by typing. Is that possible?
Yes. And my email is also in the slide, so happy to address them over email. Thank you, Molly.
Thank you so much, Ms. Carolina. And lastly, we embark on a leadership dialogue on hydrogen and its derivatives commercialization, exploring strategies and the solutions for hydrogen uptake across industries. I know many of the audience are anticipating this panel, and now I give the floor to Mr. Eric Rakul, our moderator and editor and also co-author of Touching Hydrogen Future and management consultant at BCG. Eric, please invite your panel colleagues on stage and kickstart the conversation.
Thank you, Molly. It was a pleasure to listen also to the previous speakers. What a great gathering, and we get to be cherry on the dialogue for the most important question: how do you actually sign a contract? And is there a hydrogen industry, or is it indeed a battle for every man and woman himself or herself? For you to decide at the end of our panel in roughly 30 minutes. Let me first very briefly introduce our panelists, and I'll just use the visual. So you see Val very prominently right next to me there, Zero Avia, who will represent and defend, let's say, aviation and hydrogen in the Offtake story. Then Naveen Ahlawat, who I hopefully, and there he's waving, will tell the story of the green steel and how we can go about linking hydrogen to green steel there. And then looking further, we have Ashwani Dudea from ACME, who were recently very nicely publicized, signing one of the most significant contracts, getting hydrogen in a derivative form from Middle East to Northwest Europe. So also looking forward to that. And we have Florian Mertz of Masdar, who are a global investor, and I'm very hopeful there is probably not a place in the world where they wouldn't be signing a contract. So also very good that Florian is with us. So now, having made that introduction, the rules of the game are as follows. I will give in the order Florian, Ashwani, then Val, then Naveen, roughly, let's say, 2-3 minutes to set the scene about what is it that it takes to get hydrogen supply and offtake commercialization in agreement for their industry. Hopefully mentioning some metrics. And so let's go for it. So Florian, please go first.
Good evening, respectively, good morning around the world. It's a pleasure being here for the discussion today. And just to provide a bit of background on Masdar as a player, which you know from the renewable energy, where we have 20 gigawatt of operations, and we are targeting 100 gigawatt by the end of this decade. On the power to X side, we are an investor and a developer targeting 1 million tons of green hydrogen by the end of this decade, respectively, the relevant derivatives. So that explains why we have naturally a strong interest in off-takers. So what we are doing, we are the national champion of the UAE. We are backed by the strongholds of ADNOC, Mubadala, and TAQA, and with a AA credit rating, we are it helps us to establish this relationship with the off-takers. We are active in North America, in Europe, and MENA, as outlined by Eric, and deliver to the core markets, which we see currently Europe, and then emerging subsequently Northeast Asia and North America. We are targeting all the relevant products which our customer require to unlock the industry, whether it's from hydrogen, green ammonia, e-methanol, or e-sustainable aviation fuel, or some other not yet that developed ones. Coming to what makes it happen to unlock offtake. Let's say what we have seen is that our partners and us, it helped to align the industries, the interests in partnership along the entire power to X value chain. That helped really to create projects which have a higher value, a higher implementation probability, and which are mutual beneficial for all the partners collaborating in this partnership. That was number one. The second one is, as we are for a couple of years in the industry, we have seen that we jointly go down the learning curve in a positive way of all the partners along the value chain, but also the support function, like the financing institutions, the legal bodies, and with having this understanding jointly, it helps to understand how we can create mutual beneficial situation and understand the other better. A topic which took a while, but now is getting increasingly in place and drives offtake is the regulation. It commenced with Europe, leading the path, and the Americas and Northeast Asia are following. And that is really a driver which helps to give a growth trajectory, what is coming between now and 2050. And fourth is that we have seen an increasing understanding that long-term offtake is a prerequisite for projects commercially viable, to make them realizable, and providing consistent supply. And thus, as Eric asked for numbers. So we have seen that earlier the companies were more used to the commodity status of these products and offered the typical offtake ranges. Now we see offtake ranges in the 10 to 20 years bandwidth, and with some exemptions also in the 25 years. So which really unlock this extremely capital intensive projects, as my presenter from the World Bank showed, feasible. Nevertheless, there remain some challenges for the offtake. The first one we see is increasingly the infrastructure. There's an infrastructure on two levels. The inland offtakes, where we are missing terminals, cracking facilities, storage, and pipelines. And for the seaborne transport, we are foreseeing, as the numbers will more quickly grow than we all anticipate, a shortage of the relevant size transportation vessels, and on the other side, the size of them to allow economic transport. Second challenge is the short-term willingness and ability to pay a premium to kickstart the industry before the regulation drives the demand. If nobody is willing to pay that premium, we will, what was outlined by first Ammonia before, we will see a significant step in the prices, which we can only avoid if we start now by driving this. Third challenge is the scale of the subsidies, which is often still too small for large-scale projects to make a real difference to build it or not to build it. And second is the decision speed and the uncertainty of the subsidies, which is taking too long and thus delays projects. So that gives a sign of hope on the other side, and a sign of, let's say, we still need to work on it to come over the challenges. And with this, I hand over to Ashwani.
Fantastic. And I think you perfectly preluded all the challenges that hopefully Ashwani will tell us he solved, because you had this beautiful PR announcement. We were talking before in preparation of this panel, you know, it took you roughly 20 months of hard work. I mean, a child can be born in that time. So it's quite a time. So we look forward to hear how you solved Florian's challenges, or perhaps raised some new ones as well, because Val will come after that, right, as an off-taker. So you may want to pick up the ball. Ashwani, please, floor is yours.
Thank you, Eric, and thank you, Florian. So let me first of all thank the organizers for inviting us to participate in this one. And there can't be a better opportunity than to be moderated by a panel like this. So a very short and quick introduction. ACME is about 23 years old organization. We started with power management systems for telecom sector. Very disruptive technology helped the cost of mobile telephony come down by nearly 2/3 in India back in 2003. In a matter of 1 year, we were a $500 million company due to a patented power management product, which was developed by our founder chairman. So very, very technically oriented. And since then, most of the work which we have done is on disruptive technologies. We are talking here right now about hydrogen and ammonia. Back in 2020, we commissioned our first fully integrated green ammonia plant in a western state of Rajasthan, 400 kilometers west of Rajasthan, in Delhi. And that plant is now running for more than 2 years in continuous operation, loading 1 truck of green ammonia every 12 to 15 days. And we are selling, of course, that volume as gray, not green, and we are not making any money, but it has given us a lot of confidence and the necessary experience required to develop a much larger scale facility, which we are developing in Oman. And as Eric mentioned, just a few weeks ago, we signed a binding agreement with Yara, which is one of the largest ammonia traders as well as consumers in the world. This is for offtake from our Oman project, phase 1, 100,000 tons per annum capacity, a long-term bankable contract. And as some of our previous speakers mentioned, the biggest challenge in the offtake, in the ammonia development or hydrogen development is really the offtake, because there is no hydrogen industry. There is, as Joel was mentioning, LNG industry, there is oil industry, and there are several other industries, but not really a hydrogen or an ammonia industry. And that makes things very challenging. So in our case particularly, there was no precedent. What we were negotiating was a blind spot for both us as well as our counterparty on the other side. And we learned a lot in the process. It took nearly 20 months, as Eric mentioned, to negotiate. But you would expect in a first of its kind agreement in the world to take that much time, because again, no precedents, and you're signing the contract for a period in which you don't know how the regulations are going to shape up, what will be the geopolitical situation, what could be the prices. One of the biggest challenge in developing these projects is the expectations. partly true, but mostly artificial, that the prices of ammonia and hydrogen are going to come down significantly from where they stand today, and hence the lack of commitment by buyers to commit on a long-term basis. And the reason I say it is partially true but partially incorrect is because, you know, the entire value chain comprises of renewable power, it comprises of electrolysis and then ammonia loop. And electrolysis is where the most efficiency is going to happen, because the other two are relatively mature. Ammonia is 120 years old technology. Renewable power is more than 25 years old technology now. And any benefits or efficiency benefits are going to be very incremental. So the most benefits are going to come from electrolyzer, which is only 25% of the total project cost. So to expect that the prices of ammonia will come down from X to 50% of that X is a very, very artificial expectation, and keeps the buyer at the not willing to commit on any long-term volume. So that, and it's a circular loop, chicken and egg, as Timo was mentioning. Whether you wait for the demand to pick up to develop a project, or you develop a project and then look forward to demand coming up.
Ashwani, one immediate question.
Yeah.
Wouldn't you then have a price reopener every 3 years? In my when I still had more hair, I used to sell natural gas in millions, and the deals I would kind of see 10-15 year contracts had every 3 years a price reopener, because even in liquid markets we don't know the future. So isn't that just a solution? And if not, you should have told me earlier. I could have told you.
It is partly, but look, I come from oil and gas background as well. 20 years in Shell, 3 years in ADNOC, and all my life I have done oil and gas except the last 2 years. And you're absolutely right. There are tools and commercial structures which are available to mitigate that risk. But how are banks going to look at it? 75%. 60%, 65%, whatever debt equity ratio you want to consider, is still being funded by the lenders, and they want some certainty in the cash flow. Any breakpoints would mean disruption in the cash flow. But also, what happens if the buyer and seller are unable to agree to a price? You can be left with some stranded volumes which are out of market, or maybe you do not have any off-taker for that, and the lenders are going to be extremely suspicious of or skeptical about funding such projects. So yes, when there is enough liquidity, as some of our previous speakers mentioned, where you can buy and sell at a short notice, you can find a way. Today, there are only 50-55 ammonia vessels in the world on the water. If I want to charter a vessel, if I have a tank top situation and I want to charter a vessel, it will take me at least 3 months, 4 months notice, and by then, I would have to stop my production for a very long period. So it's not so straightforward. It is one of the solutions when there is liquidity, and whether that liquidity comes in 3 years or 10 years, I don't know. But this will definitely not take as much time as it took in LNG back in 2002. When I started my LNG career, there were only about 60-65 LNG vessels. Today, there are 750. The trade back then was about 110 million tons. Today, it is 400 million tons. So hopefully, whatever LNG has taken time to achieve in 22, 24 years, ammonia will take perhaps half of that. But let's not expect that it will happen tomorrow. And until then, there will be always this challenge of chicken and egg.
Thank you. Thank you for that. Great opening. Do you have a pass-on question to Val, who is now next to set the scene? As an off-taker, any one-liner you would like Val to think about as we pass it on to him?
Please tell us what can we as a project developer do to expedite your decision making, and we will try and do that.
Absolutely.
Well, the scene is yours.
All right, thank you, Eric, Shwani, rest of the panel. So Val Miftakov here, CEO, founder, Zero Avia. We're, I think the market is naming us more and more so the leader in the green aviation space, specifically hydrogen aviation space. I started the company 6 years ago. Before that, it's infrastructure for electric vehicles. So know a thing or two about building large scale charging infrastructure, fueling infrastructure networks. And of course, great to see here our friends from Masdar as well, as we have a partnership with Masdar on the infrastructure for hydrogen development at various airports. So for us, really, as we thought about the future of aviation, it was clear that hydrogen will play a very significant role. We think that will be the primary energy vector that will drive aviation to the new zero emission future. If you look at all types of energy carriers for true zero emission flight, hydrogen quickly rises up to the top, and specifically hydrogen electric, which is the modality that we are taking, which is hydrogen stored on board the aircraft and then converted to electricity on board the aircraft through fuel cells, and then around through electric motors to produce propulsion, right? So that's our primary objective and primary technological space. We have all these key technologies in-house that we've developed over the last 6 years, and already have flown a number of prototypes now in certification with 2 out of 3 agencies worldwide for our first product. And the first commercial flights are coming in as early as 2 years from now. So really making good progress in the across the last few investment rounds as well. We've accumulated the support from the entire ecosystem in aviation and beyond. So Shell is one of the major investors. We have partners such as Masdar, NEOM, and the Saudi funds are also part of the investment story here. Airbus led our latest rounds. Some large banks like Barclays co-led the rounds, and they're looking at deployment of capital into the infrastructure and into the engine space. We have 5 out of top 10 airlines as customers and investors in the company, with a total order book of over 2,000 engines at this point, which, just to give an idea of the scale to this audience, if you just look at the typical fuel utilization of these engines, 2,000 engines across our order book that's already on a pre-order would amount to about 1 million tons a year consumption. Right. Of course, we start commercial applications in 2 years, and then this deployment of 2,000 engines is not the first year, but probably over 7-8 years. But then again, this is our current order book, and we're expanding on that. So, but already you see quite significant volumes.
I love that. That's 10 steel factories. So, so just to already put some competition for later. But
yeah, you've
please go on.
You've seen those volumes, yeah. So of course we start with smaller aircraft and go to larger aircraft, but eventually the entire aviation will go to hydrogen, and Airbus said as much already from the sort of large aircraft manufacturer standpoint. But if you think about the fuel consumption, it's 100 billion gallons a year across the entirety of aviation, and if you do the energy equivalents, that's 100 million tons a year of potential hydrogen that goes into that market. Yeah, so 1 million tons that I'm talking about is just 1% of that that we see in our order book today. So the growth from there is another an order of magnitude plus. And we really think that aviation is the best market, or one of the best markets for hydrogen, because the break-even price is quite high. So for my first product that I'm looking to bring to market in 2 years, the break-even cost for hydrogen is about $6 a kilo, which is quite an attractive point. Yeah, so I can have an operation of a smaller aircraft competitive with jet fuel at $6 a kilo. And that's before you take into account any of the IRA subsidies in the US or ETS subsidies in Europe and so forth, and all the green credentials. Yeah, just in the economics, I would be able to run better economics for my operators at $6 a kilo. Another thing is one of the highest break-even numbers across all the industries, really. And that's a reflection of the fuel is expensive for aviation, and it's a relatively highly refined fuel, highly controlled fuel. And we know how to make pure hydrogen for the purposes of various industries already. So the industry knows how to do it, and we'll see a significant expansion of capacity there. So I'll stop here with my...
yeah, great. One quick question. So because I think that was also a bit Ashwani's wish. So $6, I agree. There are projects I've seen were cheaper than that to deliver supplies. I guess they will need to get that hydrogen to your airports. So it's already in the money, which is amazing. So when are you announcing this big tender? Like, I mean, I was just looking earlier before, for example, ThyssenKrupp is running a tender for, 150 tons a year. They will take hydrogen, blue or green, from 2028, 2029 in Duisburg, whoever can get it there, right? So is there, and I mean, earlier we saw Total Refining last year announced 500 kiloton, 6 places in Europe. If you can bring an offer, they were interested, which is kind of roughly what you were potentially looking for, 1 million ton. So is there going to be like this public tender from your side, something similar to get kind of your, because if you say $6, I predict you may be more successful than the European Hydrogen Bank, which drew 132 bids. So yeah, where can people send the letter?
Yeah, so you will see, great question, Eric. You'll see some action on this this year. Yeah, as we so where we are right now, we have these pre-orders, we have a number of operators. We're now sequencing them into the operating sequence and the production lines, which means that later this year we'll have an exact idea of our rollout plan with respect to the airports. We've already pretty much classified and prioritized top 100 airports worldwide for the purposes of our product introduction. And there are certain clusters of airports. And in the next several months here, we'll be finalizing the sequence based on the launch operators. And that will drive the actual tenders and deployments.
Amazing. What is your pass-on question to Naveen?
I think, we'd like to see how we will all get all this great green hydrogen in volume when everybody is going to be competing for that, right? So we heard ammonia, you heard me, right, for aviation, and then steel. How are we going to ramp the demand or ramp the supply rather? On this at the right price levels.
Yeah, thank you, Will. Naveen, floor is yours for probably 3-4 minutes, and then we'll go for a final round across us, and then probably we have to finish with a cliffhanger, given we are a bit overrunning time. So Naveen, please go ahead.
So thanks, Eric, and great to see you again after a long time. So yes, just to introduce my company, we are Jindal Steel Power Limited. We are India's 4th largest steel manufacturer, and as we speak, we are augmenting our steel capacity by another 5 odd million tons in India. In Oman, we are the largest steel manufacturer, and in Sohar, which is in the northern part of Oman, we are running one of the world's most efficient natural gas-based DRI plant. The capacity of the plant is 3 odd million tons, and the carbon intensity from this plant is 1.47 tons of CO2 per ton of steel, which is like close to 45 to 50 odd % lower than the global average of 2.4 tons of CO2. So as we speak, we are putting up one of the world's largest green hydrogen ready steel plant in the eastern part of Oman, very close to Ashwani's plant in Duqm in Oman. And the construction as we speak for the first 2.5 million ton steel plant, it is in advanced stage. and we plan to commission this battery or this plant by FY 26-27. The technology for the DRI making has been already ordered on Energy Iron. It's a consortium of Tinova and Denelli, both Italian companies. And for the downstream facility like electric arc furnace, the caster and the rolling mill, we are going to place the order within the next 1 odd months. We are in advanced stage of commercial discussion with all the marquee supplier partners like Prime Metals and Denelli and the SMS of the world. So I think the issue here is about the availability of the hydrogen, and I think we are in a sweet spot where we have close to 6 odd project within a vicinity of close to 150 kilometers of our plant, and we have Shell of the world, we have BPs of the world, the CIPs, and the NG and POSCO consortium. So that is one of the options that we have. Also, we can build our own plant where we can also tie up with a reputed EPC partner to really bring it up to the speed, because we cannot wait till 2030, 2032 when we are expecting that the price of or levelized cost of hydrogen will fall to $1.5 per kg. We strongly believe that there is an amazing synergy that can happen between the hydrogen production on the upstream side and on the downstream side where we are putting up the steel plant. One of the example or couple of example is first the valorization of the curtailed energy that is going to happen during the daytime. We can feed that curtailed energy instead of wasting it or pushing it back into the grid. We can use that curtailed energy in our steel operation, in our powering our electric arc furnace. Number one. Number two, the oxygen that is going to come out from the electrolyzer, we can use that oxygen, we can valorize that oxygen by putting it into our DRI furnace or electric arc furnace. So close to 60% of the oxygen that is going to come from the electrolyzer, we can use it in-house, which anyway we are buying it from companies like Linde and Air Liquids and Air Products of the world, right? So these are the two advantages. Third, our experience of putting up the mega steel projects in every 3 to 4 years. That is also, how we handle our project procurement, how we handle the project management, how we handle all the technology partners, because the entire burden is going to come, so far as our steel industry is concerned, only on two poor technology partner, that is Midrex and Energy Iron. There is so much of bunching that is going to happen. Everybody will be jumping the bandwagon for DRI electric arc furnace route, which commands only 6% of the global steel making capacity at this point of time. It is going
Naveen,
to... Yeah.
I can feel the love for steel coming from your speech, but I'll have to be a bit more neutral. So I think going back to Val's point, if there is a global tender, and we do see that it's still a scarce project, and Val company would issue a tender for that magical 1 megaton a year, then and Val, you just mentioned a figure of $6 per kilogram. Naveen, you mentioned $1.5 per kilogram. Well, then I don't need a lot of rocket science to predict that the scarce bidders will first invest time to try and win the favor of Val's tender. And then whatever they have left, they will optimize, as you mentioned, and they would direct it towards steel offtakes, right? So is that the way you would see this kind of, battle of sectors evolving? We just let the price decide? Or what would be your advice to the question Val asked earlier, Naveen? How do we perhaps, as industry at least, suggest that the direction of thinking is how the sectors that are emerging in parallel as key demand points for hydrogen should look upon implicit competition between each other? Because, I mean, if no thoughts are expressed, I guess it will be pure economics, and perhaps a bit of geopolitical supply chain consideration, right? So
absolutely, Eric. I think, everybody loves their own sector, but we strongly believe that for our sector, we are the pure consumer of green hydrogen. We don't have to convert into green ammonia, make it and ship it, creating all the infrastructure, and then again recracking the green ammonia into hydrogen and then using the hydrogen, because we strongly believe it brings close to 50 odd percent of inefficiency. So in our case, it is a very simple case. We need green molecule over the fence, we generate, and then we use directly into our DRI furnace, make green steel or low carbon emission steel, and then ship it to all our customers. And the demand is already there. Europe is, it is acting as a torch bearer. 100 million ton demand by 2030. If we just, include all the announced capacities of green steel in Europe at max, we'll be able to hit 15 odd million tons. So there is an upside of close to 85 million ton. If we really take a pessimistic scenario here, I think there will be 30 to 40 million ton demand, green steel demand. So for us, our focus is absolutely to get the green molecule at the right price, because it is not that $1.5 per kg has come from the air. We have done the backward calculation from willingness to pay the green premium, because as we speak, we have already signed close to 4 odd million tons of green steel MOUs. And this year, we are going to convert all those MOUs into MOAs, that is Memorandum of Agreements, right? And as we speak, we're in a very advanced stage with a couple of customers to convert those agreements. So basis the green premium that is coming from the customer, plus your levelized cost of hydrogen, that is what it really, basically decide that yes, how much we have to go. Our requirement, it is a fixed requirement. What we are talking with the developers or with our own calculation, acting us as a developer along with the EPC contractor, that there are price points. There's every value chain. In the value chain, we can optimize the levelized cost of, and Oman can be one of the country where the levelized cost of energy can go as low as $1.4, $1.5 per US cents per kilowatt hour, because of the very good sun intensity and the wind velocity, which is at par with Netherlands. So basis that, we strongly believe Oman can really be a country, one of the best place where we have a very good chance of producing the real green steel first time.
Very good. Very good. By the way, I'm sure our friends from Oman are very happy with your advertisement. To be fair, there is now an emerging trend. I don't know, Morocco just announced 1 million hectare provision, and the bidders are invited during this year to also come and suggest projects. So I think there is some good supply coming up. It's still, I would say, a very good question Val asked. So I suggest we just go across the panel. What's this kind of view? So the way I would summarize your answer, Naveen, is, in a certain geography where you're very close to your suppliers, you will be the best option because, you do consider there will be enough hydrogen both for you and for the airports, so to say. That's the way I'm hearing your answer. Let's go maybe briefly to Ashwani. Ashwani, how would you see that competition between the industries emerging? And then after Ashwani, I'd like to go also for a concluding remark to Val, and then finally to Florian. Ashwani, how would you see this kind of industry going forward, competition between sectors or no competition going? What are the rules of the game?
Yeah, I think it's very simple to be in a webinar or conferences, and the common joke for us developers, project developers, is that these days the only people who make money in hydrogen industry is the guys who sell coffee in those conferences, rather than the project developers or the buyers. So it's very easy to make a very bold statement on prices, on long-term offtake commitments, but lending money, green financing, the COPs and everything which happens across the world. But in reality, there is a lot of catch when people start talking about making actual commitments which have to be backed by guarantees, either supported by a bank or through the parent companies, etc. That's when things start becoming real, and that's where I think a lot of people start backing out. Of course, the tenders which you just mentioned, Eric, the Total tender and the ThyssenKrupp tender and the H2 Global tender, which Timo mentioned about earlier, are some very, very good opportunities. The upcoming CFD schemes in Japan and Korea are all very great thing. And my view is that no buyer, whether it is in steel industry or any other aviation, or I mean, of course, there will be only two ways, according to me, in which the demand will start happening, and that is either by way of mandates. As Val mentioned, there is a requirement for airline industry to move into sustainable aviation fuel. It is a mandate, and everyone will have to follow. So there is no specific edge one player in the industry has over others, and all of them are in the same boat, and probably they will pool also some of their demand together to make sure that they all get affected, impacted, or whatever by the same price. And the second way in which the demand will happen is only through contracts for difference scheme, because we are still talking of a situation where there is at least 3, if not 4 times difference between the gray prices, fossil fuel based gray prices, and the green prices. So here, oil and gas is not going to stop tomorrow. In fact, I've been reading what's happening in Houston right now, where CERAWeek is the largest gathering of oil and gas professionals, where I have attended at least 15 of those versions. Is happening that energy transition is actually a fantasy. And I mean, I don't completely disagree with those statements, because it is indeed a fantasy at the moment, because the prices are very, very high, and there is not enough willingness amongst the buyers. The expectations of $1.2, $1.5 is never going to become a reality until until there is a more and more projects come and economies of scale, which we talk about, happen. So my view is that the two things which are going to drive really are mandates and CFDs. And that will be the market for next 4 to 5 years, according to me, before the technological developments bring and the economies of scale start bringing down the cost, not at parity, definitely, with the fossil fuels, but in the meantime, fossil fuels hopefully will also start increasing in price due to carbon tax, etc. And there will be at some point, where the difference is just about enough between the green and gray, where the buyer will start taking commercial decision on their own without having a mandate or a CFD requirement.
Yeah, excellent. I like that. We go then to Val and then to Florian. And in 5 minutes, dear listeners, we will be concluding. So, Val, any final reflection on this, now that you got a bit of wisdom from the other panelists? Will you be doing something differently now that you listened to our discussion today about your possible tender some point later in the year?
I think we'll be doing exactly what we're doing, and I think there will be a significant market, mechanism around where these volumes will go. The use cases that can offer a higher price will be prioritized by people who can prioritize them. Now, there will be, of course, situations when you have captive supply, basically, in some area that is either stranded for electricity output, like some of the areas in the United States and some of the other countries as well, or constraint on the output of hydrogen or ammonia, and there it would make sense to co-locate the use. When you can move the use, you have more flexibility. We unfortunately cannot move the use because our aircraft has to refuel at the airports, and airports are where they are. So we need to get hydrogen to those places. Sometimes we think it will be the most economical thing to do would be to produce hydrogen at the airports or near the airports, at the fuel farms and whatnot. That will probably drive the cost up from compared to if you put the production in a desert somewhere and co-locate it with a steel plant, for example. So you will have those dynamics, but market is the market, and it will drive it. And for aviation, I'm pretty excited about this, and I think all hydrogen project developers and producers should be excited about this, because nothing else will work for aviation but hydrogen. No matter what modality of hydrogen you believe will take what percentage, right? It all starts from hydrogen, yeah. So either you burn hydrogen, or you do it, you use it in the fuel cells, or you use it to produce power to liquid fuels. It's all starting from hydrogen. Nothing else will work for aviation longer term. And at the same time, as I mentioned, you know, the base price of the fuel is one of the highest out there. So that just situates us pretty well in the economic terms there. So I think it's a bright future for aviation use of hydrogen there.
Yeah, I was hoping you would post a link to buy a ticket in 2 years for one of the flights you guys going to facilitate, but maybe that's in the next webinar. So we'll look forward to that. Florian, concluding remarks on your side, reflection how the industry may go about it, right? You heard a few remarks, and hopefully you got some answers to your challenges you posted early on.
Yeah. So from our side, let's say what motivates us is kind of the regulation which we see is starting to drive these decisions. And my other colleagues alerted it, but particularly when you look at Europe, you have got a series of milestones like that when you get on stream before the 1st of January 2028, you avoid the additionality. That drives a wave of projects. The next wave is what drives Val is the use of eSAF, which by 2030, yes, it drives the demand by itself. The second one is we see also the maturity of the technology now coming. We had a couple of startups of pilots. Everybody struggled getting done, but they learn with each of those. And now you see the first standard modules coming up from suppliers with triple-digit megawatt numbers, which haven't been imaginable even a few years back. So that takes one to make it happen. The overall point, what we see and what is in our DNA is that partnerships drive it. Whatever is your final product, you need to drive a partnership along the entire value chain. And you need to start now with this partnership, because if we don't start, then we have no chance to get down an experience curve. Yeah, to wait for others to do this will not help. So our word out is build partnerships along the value chain and get started with these projects.
Fantastic. I also kind of hearing there that those who think they're open to that partnership to build should be reaching out to you, Florian, on LinkedIn. So I want to applaud the panel for a great discussion. I mean, we got some nuggets of wisdom and even some prices. Hopefully this leads to inspiring thoughts and people reaching out to actually offer supply or ask for offtake. So thank you very much. I applaud, even though normally we would be a bit more louder together. Molly, for you to wrap up and tell people where they can download the video if they want to look at it again and think about it. Thank you.
Thank you so much, Eric, for moderating such a wonderful panel, and also to Dr. Val, Naveen, Ashwani, and Florian for contributing to such a meaningful dialogue. We have all learned a lot, and with this knowledge, we are more equipped to embrace the next chapter of PACE development. Also, I want to express my sincere appreciation for your company and our audience company over the past 4 hours. But this also demonstrates the strong enthusiasm that the industry has for the topic and their motivation to collectively forge pathways forward. A big thank you to you all. Regarding today's video and presentation slides, we'll share with them on our official website and also on LinkedIn next Tuesday, along with some key insights from the webinar. If you have any further inquiries, please don't hesitate to reach me out at molly@leaderassociates.com. Furthermore, I would like to remind you that this webinar serves as a virtual preview of our in-person event, Investing in Green Hydrogen 2024, scheduled on September the 2nd to the 3rd at Queen Elizabeth Centre in London of UK. We encourage you to secure a pass and be a part of this remarkable occasion. We eagerly anticipate your presence and engage in fruitful discussions. And now this comes to the end of our today's 4-hour webinar. See you next time and take care.